Good afternoon, everyone. We are welcome to day 2 of the Strategic Virtual Financial Reporting Workshop. Okay, today is 17th day of January 2021. And today we'll continue with the final lap of the introduction to international financial reporting. And yesterday we introduced ourselves to financial reporting and also try to understand the objective of financial reporting, the role financial reporting plays in every business organization, and the role it plays within the global economy. And therefore, we went further to talk about the frameworks that exist within financial reporting. Okay, and we concluded yesterday that we have two frameworks. The first framework is the regulatory framework. And the regulatory framework speaks to laws, regulations, and form of generally accepted position that regulates the field of financial reporting across the globe and in different jurisdictions. Doing so, we discussed about local regulation, and we picked Nigeria as a case study. And also we spoke about international regulation, where the regulation of financial reporting starts from Ifrs Foundation. Okay, and we also try to look at the structure of Ifrs Foundation and the functionality of it. Within the local regulation, we also kept abreast of the fact that FRC Act more or less serve as the peak for financial reporting in terms of regulation. Everything that affects financial reporting is drawn from the FRC Act, followed by some secondary regulations and acts that equally support such based on industry and based on the status of many companies as a legal entity in Nigeria. There, we talked about CAMA, we talked about BOFIA, we talked about CBN Act, we talked about Prudential Guideline, we talked about Insurance Act, Pension Act, and etc., of which certain paragraphs and sections within those acts deals with financial reporting in Nigerian context. Okay, for the international context, we identify the organization that is responsible for financial reporting across the globe, which is the Ifrs Foundation, of which we know that the foundation ship is spearheaded by the trustees. Okay, and the trustees is made up of 22 members, which we described yesterday. And also further, we understand that we have about 4 organs within the foundation that make it function. The first is the monitoring board. The monitoring board is expected to intermediate and more or less liaise between the trustees of the foundation and public authorities on areas of financial reporting improvement and regulations. We also talked about the IFRS Advisory Council. They serve as advisor to both the International Accounting Standard Board and the trustees in the foundation. Okay, we also talked about International Accounting Standard Board, the IASB, which is a technical org, which is a core and the heartbeat of the foundation, responsible for the development and implementation of accounting standards across the globe. And finally, we talked about the subset of the International Accounting Standard Board, which is another organ we call the IFRS Interpretation Committee. And that also is responsible for issuing interpretations and guidelines in order to support financial reporting system across the globe. Finally, we ended up by talking about the financial reporting systems that operate within the world. And we're able to narrow it down to identifying that we have 2 systems that are operational over time. The first is a rules-based system, and the second is a principles-based system. I will try to more or less demystify that and try to reach a conclusion or a compromise to say IFRS is much more of a principle-based system than rule-based, even though we're able to establish that in every principle, there are still some set of rules. Okay, and likewise, you talk about rule-based. An example of rule-based system, financial reporting system we mentioned about was the US GAAP, and also our former standard, then Statement of Accounting Standard, during the days of the Nigerian Accounting Standard Board, which you know then as SAS, okay, which most part of it is no longer applicable because of Nigeria's adoption of IFRS in 2011 through the instrumentality of the Financial Reporting Council Act of 2011. I think that's where we stopped yesterday. Today, we'll be taking opportunity to look at the second framework, which is the conceptual framework. The conceptual framework. Okay, before we move into that, I want to invite any question we have at hand based on what we discussed yesterday, which was the day one section. If there's any clarification, research you've done, things that more or less you've considered and you need further clarification about, I will appreciate us to speak to that now. On that premise, kindly raise up your hand if you have any contribution before we proceed to Conceptual Framework for Financial Reporting as issued by IASB. By a show of hands, if there's none at this point, I think we could proceed to Conceptual Framework. Now, let's try to understand what is Conceptual Framework. Now, when we look at it from the word conceptual, what does that mean? Conceptual or conceptualization of idea means ability to identify an underlying principle that is expected to guide the practice of any field. And that's what we mean by conceptual or conceptualization. It's a form of principles that tends to actualize your idea and your objective. Now, let us liken it to financial reporting. When we talk about conceptual framework for financial reporting, what do we mean? This is a body of principles that underline financial reporting as a system. Okay, and simply put, this more or less serves as a platform. It serves as the basis, it serves as the foundation to which financial reporting is built. And that's what we can say about conceptual framework. And therefore, it's more or less what creates a culture within financial reporting where every other thing that operates or is developed within that financial reporting system more or less drives or gets its life from. Such that in every system, there's a culture. So that even when you're coming in with your own culture, once you come into a new system which has a culture, over time you're expected to embrace that culture. And which means that culture more or less serves as a form of guidance that has been set in terms of principles that are expected to be followed in order to achieve the primary objective of that group. And which group are we talking about now? Financial reporting as a system. Therefore, I could say that conceptual framework is more or less like the alpha, the omega of financial reporting. It is the beginning and it's equally the end of financial reporting. It's the head, it's the body, and it's the tail of financial reporting. Therefore, we see conceptual framework as the entire principles that underlie the way and manner financial reporting is carried out to achieve its objective. And that is what I can say about conceptual framework. Now, the first time conceptual framework was drawn was when IFRS, by way of change in nomenclature, moved from the nomenclature known as International Accounting Standard, as initially issued by the International Accounting Standard Committee starting from 1973. But in 2000, 2001, there was a paradigm shift where IASB metamorphosed into a board, which we call IASB, International Accounting Standard Board. And this was as a result of the institutionalization of financial reporting globally through the creation of IFRS Foundation. Now, IFRS Foundation harbors International Accounting Standard Board. Now, upon the creation of the board, there was a drift and a shift from rule-based to principle-based. Now, in order to harness that, that is when Conceptual Framework was created as a document of the IASB, which will guide IASB in future in order to give guidance towards how standard is being set. And that's what we need to understand, which means it's like when you look at Conceptual Framework for Financial Reporting, it can be likened to the constitution of a country, where every other act or regulation that is drawn are drawn under the principle and the spirit of the Constitution. Which then means that Conceptual Framework is like our own constitution if you see financial reporting as a country. Which means the constitution of that country, which we call financial reporting as a country, is the Conceptual Framework. It's a document that summarizes all of the objectives and all of the intent and processes towards achieving those objectives, so that we don't materially deviate from those principles. It gives us the guide at every point in time towards achieving the objective of financial reporting. I now find out that at every point in time, when IASB want to set a standard, want to revise a standard, or want to carry out an update in terms of interpretations and guidance, what you find out is that at every point in time, they revert and resort to the Conceptual Framework, okay, so that any standard must be in tandem with the principles and the spirit of the Conceptual Framework, okay? And where there's a need to deviate, it always leads to a form of amendment to Conceptual Framework. You find out that the first Conceptual Framework was in 2000. Later, there was an update in 2010. Of recent, now we now have a Conceptual Framework that was issued in 2018. It came into force in 2018, even though it was issued March 2018, and it's expected to take preeminence from 2020, okay? But again, early adoption was embraced by many in order to key into the narrative of the modern day financial reporting system. Now, the Conceptual Framework we'll now be discussing is the most recent document of the IASB, which was issued in March 2018. And we're going to discuss that. The Conceptual Framework is a document that has 8 chapters. And those 8 chapters addresses all what is expected of us within the financial reporting system. And that's all what we're going to look at today. But again, the first thing we also need to look at is, let us try and identify what role does the Conceptual Framework play? Okay, what are the objectives of the Conceptual Framework in line with the documentation that is made by the IASB? Now, I'll take us to the objective of the Conceptual Framework. Now, let's look at this. You'll find out that the Conceptual Framework enlists all of the concepts and principles that tends to underlie the preparation and the presentation of financial statements for the users of financial statements. Today, we are going to demystify and try to identify who are the real users of financial statements. Okay, now let's look at it. What purpose does the Conceptual Framework have with respect to this? And I'm going to show you one by one, and we might more or less brainstorm on it and try to understand what role it plays. Now, let's look at the first one. The first one here is that it assists the board. When we talk about the board, in this case, we are talking about the International Accounting Standard Board. Okay, it assists the board in the development of future standards, and also when existing standards have to be amended, which means at every point in time, and that's why when you follow the due process of standard setting, you find out that one of the technical jobs that will be done is that any standard or amendment that have to be made must be reviewed to be in tandem with the principles and concept of the Conceptual Framework. As we move on, we are going to unveil those principles and concepts as we move on. The second thing you need is that you need to understand that the development of the conceptual framework as a document of the IASB do assist the board in the promotion of harmonization of accounting standards, regulation, and every other procedure that leads to achieving the objective of financial reporting. Now, one of it is what led to the convergence project of the FASB, that's the Financial Accounting Standard Board of the US, and the International Accounting Standard Board, with respect to aligning their principles and concepts in order to ensure that material differences between the principles under IFRS and the rules under US GAAP are not materially different. And that is the position of this, the conceptual framework, which means it creates a form of alignment between all parties. Another thing that conceptual framework assists in doing is such that at every point in time, where some other local regulators, such as the Nigerian Accounting Standard Board those days, which is now the Financial Reporting Council, such as US GAAP, such as New Zealand Financial Reporting Institute, and some other ones across the globe, they harness the conceptual framework in their own development of local standards, so that it is not materially at variance with the internationally accepted set of principles and concepts. Okay, it also assists you and I, who are preparers of financial statements, where we are experiencing transactions that are not expressly addressed by an existing standard. We need to fall back to conceptual framework to have or borrow a leave towards having to appreciate the understanding of that transaction with respect to the element it has created within the financial statement. And that can give us some level of guide towards the recognition and the appropriate measurement vis-a-vis the disclosure that is required for such in the financial statements. Another thing that's also beautiful about conceptual framework is that it assists auditors in the expression of their independent audit opinion where such is needed, especially in areas that are complex or areas that are gray or areas that are more or less yet to be addressed specifically by accounting standards that are already put to use or that are in issue. Okay, that is also important for us to note. Another thing that is also possible about it is that various users, which we are going to discuss later, various stakeholders that make use of financial statements want to have better informed knowledge about analyzing, about reviewing, about understanding the information contained therein in the financial statement. Therefore, what this do is that those users, by their familiarization with the content of the conceptual framework, will give them edge towards appreciating the information contained in financial statement. Okay, and finally, it also assists those that are interested in the work of the IASB, researchers and staff of IASB, to have better information about the process and the approach and the spirit that exists within the IASB in the development of accounting standards. These are the things that serve as the reason why this document was produced, which means the document is a first reference point in financial reporting, both to the board, both to regulators, both to the preparer, both to those saddled with the responsibility and governance over the preparation and presentation of financial statements, the auditors, the users, and the general public as a whole. This document is more encompassing. And as I've said earlier, this document has 8 chapters, okay, based on the reissued standard. And what are the chapters? The first chapter laid the foundation towards identifying and appreciating the objective of financial reporting. This is not invariant with what we have been discussing, even as at yesterday, where we talked about the primary objective of financial reporting as a system. The second thing we also understand from chapter 2 is to harness and try to appreciate what are the qualities that are expected of a financial information. What qualitative attributes exist in a financial information that can be relied upon for decision making? Another thing we also need to embrace is that Chapter 3 makes us to understand what financial statement stands for. If you could remember, in our discussion during the regulatory framework, where CAMA make emphasis to annual report and also make emphasis that in an annual report, a component of it is a financial statement. We try to explain what financial statement is, and we define it today to say what constitutes a financial statement from Ifrs perspective, and what seems to be the components of financial statements. Okay, and what type of financial statement can we have as a general purpose financial statement, and which reporting entity is responsible for the financial statement we produce? Okay, these are what we are going to more or less get in touch and have better understanding about in Chapter 3. Chapter 4 speaks to the element of financial statement. You find out that in my discussion about conceptual framework, where I said it assists auditors, it assists preparers in trying to address certain transactions with respect to identifying the elements that they've created and how those elements are recognized, measured, and disclosed. Okay, now we need to have a better appreciation of what are the elements of financial statements and what purpose does each element serve. And thereafter, that will lead us to Chapter 5 to say, having identified the elements of financial statements, the question then is, how do we go ahead recognizing those elements? Which means, what process do we take towards recognizing them in our books of account? And again, what process do we take in de-recognizing them by taking them out of our books of account? What leads to that, and how is that carried out? That is what we are going to expose ourselves to in Chapter 5. While in Chapter 6, we ask ourselves a simple question. Upon recognizing an item in a financial statement, one of those principal concepts of accounting is monetary measurements, which means anything that cannot be measured in money terms cannot be accounted for or cannot be included in accounts. Therefore, the question is, what determines the value or the estimates that we make on an element of financial statement upon its recognition in the books of account? And that will lead to measurement. We have understanding of measurement at the point of initial recognition, and majorly we try to understand measurement and the role it plays and what form of measures exist when it comes to subsequent accounting as time goes on, especially at every reporting date. Chapter 7 will lead us to presentation and disclosure. Now, one thing I need to also emphasize is this. Financial reporting objective is actualized based on 3 items. The first is recognition principle is key to financial reporting. Second is measurement principle is key to financial reporting. And third is disclosure principle is key to financial reporting. And that's why I do tell people that financial reporting is all about RMD of activities and events that is carried on by a business, which then means the word R stands for recognition, the word M stands for measurement, while the word D stands for disclosure. Okay, that speaks to that fact. And we're going to discuss much of presentation and disclosure as a means to better align users of financial report to have better understanding and meaningful information in an orderly manner for the purpose of making decisions. The final chapter is the chapter that introduces us to the concept of capital. What do we consider capital? And what regime exists in identifying capital in its nominal and real terms? And again, what do we mean by capital maintenance as a concept? And how can capital be maintained within a business? Is it by introducing or injecting more capital? Or is it by increasing your efficiency level and performance level towards enhancing profitability and retaining such profitability to achieve certain objectives or meet certain goals? All of these are what we're going to discuss in Chapter 8. And at that point in time, we'll have a better grasp of the requirements of the conceptual framework for financial reporting being a document issued by the International Accounting Standard Board. And this is just the summary of what conceptual framework is all about. Okay, at this point, I will want you guys to more or less make contribution about what you've known about it before, or what you have researched about it before, or the perspective to which you have before. On that basis, I'm going to unmute all persons and try to mute yourself if peradventure you have noise at your background. At this point, I want you to interact. Let's have discussion about it. Okay, who will come in first? Shegun, what's your view?
Just as you've explained, conceptual framework is like the guiding principles for financial reporting. Just like a constitution that guides how the standard setting body engage in certain financial reporting standards, and also how preparers of financial reports goes about preparing financial reports. And it also guides the users of financial statement in interpreting the financial statement prepared by the experts. So it's just like a guiding principle. That's my contribution to it.
Okay, thank you. Ifechukwu.
Okay. Good afternoon, everybody.
Afternoon.
For me, I would say I don't really have much of a contribution, but I just want to state the fact that, how you explained it makes it no longer looks strange. First of all, conceptual framework, there was this well, we like to say knowledge gap in understanding what the conceptual framework was to the IFRSs. So now that you've explained it, it's clearer, and it's obvious that in as much as any new standards may come out in the future, they will still more or less have some form of will I say background or foundation in the conceptual framework, if I'm right. Then it also makes it easier, because now, based on our discussion, you mentioned the RMD, and it just makes it easier to be able to, like people will say, have the IFRSs or the IASs at your fingertips, because basically you already know that, okay, you probably need to know what is in the conceptual framework, which is the background of any IFRS, and then you need to know like the recognition, the measurement, and how to recognize. I feel like once anybody has these things at their fingertips are about any IFRS, it would be easier to report properly as a financial accountant should, or what we call the financial manager should. Thank you.
Okay, thank you. Olawale, what's your view?
Yeah, so based on what we explained today, so we said the conceptual framework for financial reporting is a body of principles, basis of foundation to which financial reporting is built. We also mentioned that it is a system in when you look at financial reporting as a system. It is also like the alpha and the omega, or the foundation of financial reporting. We also said that it is like the entire principles that underline how financial reporting achieve its objectives. The most recent conceptual framework was introduced in March 2018. and it has 8 chapters. We also talked about the objective, roles, and purpose of conceptual framework, and we mentioned that it assists the IASB in the development of future standards. We also mentioned that it assists the board in the harmonization of regulations and accounting standards. It also assists the auditors in forming audit opinions when they go to audit clients. That's my submission, sir.
Okay, Bemi, are you there?
I am.
Okay, can we see your camera? Can you put up your thoughts?
Okay, I think everybody has pretty much contributed to what we've been learning so far. It's pretty much saying that this is the archangel, or this is the go-to guideline for every party involved, from the National Standard Board Setting Committee to IASB to the users to auditors. This is our archangel, and to the extent that there's any deviation whatsoever, be it from the IASB, they would definitely give an explanation on that deviation. But this is the guiding principle and the underlying principle to which everything from financial reporting is being set upon.
Okay, thank you. Nuruddin, I think you want to say something.
Actually, financial conceptual framework is not a new term, but as a matter of fact, I get clearer picture of what's the purpose of conceptual framework as regarding financial reporting. I can now clearly understand that conceptual framework is the bedrock of financial reporting itself. Meanwhile, the scope and the operation of financial reporting lies under conceptual framework. As a matter of fact, the chapters contain 8 chapters contained in conceptual framework as clearly shown how financial reporting can be operated within the scope of the conceptual framework. Thank you.
Okay, Duncan.
I think we said much about the conceptual framework for financial reporting. I will just add a little bit to that what I've said so far. I think, to me, to my understanding, it represents the spirit behind those laws issued by IASB, because even in law, in a legal setting, when you are giving a judgment, there's a spirit behind it. The conceptual framework enables the body to explain or to make us know the spirit behind various policies and is being issued from time to time. So the conventional framework for financial reporting totally explain why things need to be done the way they are done. And if there's going to be a section, they explain how it should be treated and the limit upon which you can act or make use your discretion. So it also establish the boundary upon which you can exercise discretion. So you are not expected to go beyond certain points when you are using, even when you are using this discretion. That's what I understand.
Okay, thank you. Anayo.
Hello, good afternoon.
Yeah, can you speak to the? Yeah, can you speak louder or put your piece closer to your mouth? Yeah, good afternoon.
Okay. I don't really have much to say
No,
other than
no, can you speak loud?
where I joined.
Yes, it's okay. Yeah, it's okay now. Yes.
Okay. From where I joined, I actually joined a bit late, but from where I joined and what I heard you say, it's just that from what other speakers have already said, it's just making me to
come to terms more about all these key points to financial reporting, which are those things that you mentioned. You said the RMG, that's the recognition, measurement, and then the disclosure principle. So I don't really have much to say.
Okay, thank you very much. Okay, before I call on Moses, provided I just joined, Madam Oladokun, who is the nurse mother, dropped something, a note, because the voice of the baby, so that it doesn't interrupt. She said, to my understanding as explained, it sheds more light on what conceptual framework relates to in financial reporting. As it stands, which is the foundation for identifying and underlining its principles to assist users in decision making. Okay, that is our own view. Now, Babajide Moses, from your own understanding, even though you are just coming in, what do you understand by conceptual framework from your own understanding as a professional accountant? Let me give you access to unmute. Okay, can you unmute now? We are waiting for you.
Hello.
Yeah.
Hello.
Yes, we can hear you.
Okay. Conceptual framework is just simply talking about the objective that leads to creation of rules and standards. Talking about the ideas and the objectives that help us, that leads us in creation of the rules and standards we use in the financial accounting.
Okay, thank you. Let me go to Ifrs Foundation depository, which I have access to. Okay, and let me try and go back and download the conceptual framework for you guys. Okay, let me check standards. It's supposed to be somewhere here. Okay, these are updates in 2018. That's in March. Okay, let me go back to, there's a section there where I have the conceptual framework. Okay, but I can always give you the document. Okay, but I'll share the conceptual framework document to you guys. Okay, but now let's look at this video from the former chairman of the board of IASB on conceptual framework.
The IASB has just published an updated version of its conceptual framework. The conceptual framework is a very important document to the IASB because it provides the basic concepts and principles that should underpin the standards as set by the IASB. Moreover, in the very rare cases where a particular business transaction is not adequately covered by our standards, companies should use the conceptual framework as a point of reference to report for that particular business transaction. And also it is important to realize that the conceptual framework does not supersede our standards. It underpins our standards, but it never overrides the standards as set by the IASB. The IASB decided to update its conceptual framework mainly because there were some gaps in the old conceptual framework and some parts simply just needed updating. One big gap in the existing conceptual framework was that we didn't have a chapter on measurement. There were simply no guidelines on, for example, when to use historical cost or when to use fair value accounting. And that gap has now been filled in the updated conceptual framework. Furthermore, I think when people read the conceptual framework, it will be very clear that the board considers the income statement to be at least as important as the balance sheet. And it also gives clear guidance to the board that other comprehensive income can only be used in standards in exceptional circumstances. In addition, the board has improved some definitions, especially we have created a more precise definition of what is a liability, and that will help the board in its future standard setting. Moreover, we took the opportunity to clear up some confusion that was created by the previous conceptual framework. The previous conceptual framework led a lot of people to believe that the board did not think prudence to be important and that we didn't have an eye for the importance of stewardship. And I think we, in a new conceptual framework, that confusion will be gone. We have given both prudence and stewardship its proper place. The board will start using the new conceptual framework from day one, and I really believe it will help us in setting even better standards. Those companies that use the conceptual framework to formulate one or more accounting policies only have to start using the new conceptual framework from the year 2020. Throughout the project, I have been struck by how many people were interested in contributing to the new conceptual framework. So I trust that you will find this document very interesting reading.
Okay, thank you very much for that. I'm going to put you guys into two groups. You will identify those key items that are unique to conceptual framework. And you guys should more or less, from your own perspective, try to identify the rationale behind such decision. That is one. Second thing is that I want you guys to discuss what is the real advantage of IFRS as a standard. And does it even have any disadvantage? If it has, what are disadvantages? Okay, and let us try to look at that. Okay, and okay, that is that. When we come back, we are going to look at some other things and we'll now delve into the conceptual framework. And once you are able to lay this foundation of conceptual framework, every of our discussion from day 3 to day 40 will be something that will better appreciate the essence of financial reporting in every business organization. Okay, in this manner, I'm going to more or less put you guys into break room. Okay, baby, kindly join your session. Shegun and Donka, we are waiting for you. Thank you very much. Okay, we are back. Now, can group one present their position? Who's representing group one? Is that Wale? Okay, we can hear you. Can you unmute and?
Can you hear me now, guys?
Yes, we can hear you.
Okay. First of all, identifying the changes that was made to the conceptual framework, we found out that in the previous guidelines, there was no adequate guidelines on historical cost and fair value. So this updated version, they took their time out to explain further on historical cost and fair value. This in time past has caused so many discrepancies and confusion, but based on feedback from different professional accountants all over the world, they were able to give better guidance and explanation in this regard. Also, in time past, you will notice that much value or preference is being given to statement of financial position. People do not really pay more attention to the income statement. But as you all know, it is also a very, very important element of a financial statement. So this updated version, they gave more importance to the income statement as they did to the balance sheet. Another changes that was made was as regards to substance over form. There was a gray area in that direction in the previous frameworks. So this new or the updated version, they give us like a better view, a better understanding of what substance over form means and how it relates to financial reporting. They also gave better definition, or let me say a more encompassing definition to assets and liability. In the previous standards, there are some items that by the time you look at the definition of asset and liability, they will not fall within asset or liability because of the gray area in the definition. So that was also updated. When you now look at the advantages of the standards, number one, it creates a form of uniformity in reporting across all companies and across the world. It also improves the reliability of the financial statement. The financial statement can be relied upon by both the stakeholders, internal and external. It can be used to make informed business decisions. It also brings about the prevention of fraud and fraud, accounting errors, and what have you. I also find it really helpful for the auditors because they use it in forming their audit opinions. There's also another advantage that I find very interesting, and that is comparability. It allows different financial reports to be compared across different countries, across different periods, across different companies, in different sectors. Now, looking at the disadvantage, it brings about difficulty in choosing alternatives. For instance, when you look at inventory, there are different methods. You can use the weighted average, you can use the LIFO, you can use the FIFO, so most companies are usually confused which one should they use, so the standard just need to look at this and give us and shed more light on it. That's all from this group, sir.
Okay, thank you. Can group 2? Group Salah.
Maybe she can't hear us.
Group Salah, okay, let me unmute. Give me access. I've given you access.
Thank you. Duncan is going to present on behalf of our group.
Okay, Duncan.
Thank you.
Okay, good day, everyone. I'm presenting for Rwanda. In our group, we agree that for the consensual framework is like a legal precedent. It gives you basis upon which it provides a basis upon which all our standards, all international reporting standards are made, they are developed. It's just like for company, we use general acceptable accounting principle to determine accounting policy to follow. The same way IS Foundation use conceptual framework to develop, it help them to develop accounting standards in the sense that it help them to define consent, especially those that are conflicting or have ambiguous meaning. It help them to find a common ground so that when they develop accounting standards, the users or those that prepare financial statements, we have a clear idea of what that consent represents or what it tends to explain. It is not the standard itself, but it helps in developing the standard in the sense that it gives room for you to look at some consent and know how it applies to the standard. So when you are reading the standard, when you are going to the standard, whatever you are not clear about, you have opportunity to go to the contractual framework and check the spirit behind such standard. That is the essence of the contractual framework for financial reporting. It set the consent and it define the consent so that it will reduce ambiguity. It will make it clearer to all the stakeholders involved in financial reporting. So we are secondly, we also spoke about the advantages of international financial reporting standards. Though like Olalewa has rightly said, uniformity, easy comparison. For the uniformity, I will just briefly appreciate on that. When you are, let's take a company for instance that are into mergers and acquisitions. The international financial reporting standard help them to make easy decisions. It make them to be able to compare financial statements from different countries, or like if those statements were prepare using different standards or using different background as a tool for the preparation. But because they're already based on the same set, they are prepared based on the same consent, the same set of principles, the same set of rules. It makes it easy. You don't need to start trying to define what this represents, what does it represent, what does it stand for. You from the statement, you can pick it directly, and it will help in facilitating business like mergers and acquisition. And for the uniformity also, the world is a global village, and especially like we in a major country that want to go to London Stock Exchange, that want to go to New York Exchange, we need to prepare our statement in line with what those people are already used to. We need to provide a statement in line with international standards so that when investors pick it over there, they can be able to use their figures and compare whether our company is worth investing in or not. So that is the advantages of the international financial reporting standards. What are the disadvantages? I'll just pick one, which is I think is the most obvious, and that is it cannot adequately make provision for peculiar circumstances related to some environment or some companies. That is the major disadvantage of financial reporting standard. Is meant to create uniformity, but there are some circumstances that are peculiar to an organization, that are peculiar to a country, and such circumstances it cannot be accounted for, cannot be the standard will not adequately capture their peculiarity.
Okay, thank you very much.
That is all from my presentation.
Okay, now let's first of all, I'll share this video with you guys and let's check that first and have better appreciation of why Ifrs with respect to advantages and disadvantages. Okay, let's start with this.
Financial information is the lifeblood of capital markets. Every day, more and more of the world's capital transactions are cross-border investments. But how does an investor here decide whether to invest here or here or here? International investors need access to financial information they can trust. International financial reporting standards provide the global language of financial reporting. Now, well over 100 countries require companies to use IFRS standards when reporting on their financial performance. Investors around the world trust IFRS standards because they bring three key benefits to the world economy. IFRS standards bring transparency by providing high quality and comparable information. This helps investors to make more informed investment decisions. IFRS standards improve accountability by helping to reduce the information gap between those on the inside of a company and those on the outside. This helps investors and others to hold company management to account. And IFRS standards help companies and markets to operate more efficiently by having a single trusted global standard for financial information. It lowers the cost of capital and reduces the costs of reporting. Together, this contributes to the global economy by fostering trust, growth, and long-term financial stability. Find out more about IFRS here.
I feel that we have made an enormous amount of progress with IFRS becoming the global language. We had Europe adopting it first and showing leadership, but then many countries followed. The ISB is now saying 114 countries have adopted the standards. India, China, Japan are all making good strides in the direction of IFRS adoption. So I think we're making huge progress, but the big issue is still, what is the US going to do? That's the question mark. We need the US also on board, and maybe they should look at the Japanese example of a voluntary adoption, that those companies that really see the benefit of using IFRS can already go ahead, and then maybe the rest will follow.
We benefited by having IFRS out there. If we moved it even a few years later and a crisis came in and then tried to move in with IFRS standards, you'd have a wide variety of different ways to do it because you're trying to deal with the effects of the crisis. This was done before the crisis, and therefore you had the ability to actually weather the crisis with having a global set of accounting standards. So I think that's, in my mind, probably one of the best things about it.
Since IFRS was mandatorily adopted in Europe in 2005, I think the biggest benefit has really been providing a common accounting language for Europe, which was the main objective of IFRS in Europe in the first place. But also, if we look beyond Europe, at the recent jurisdictional profile that we undertook, where we looked at 138 jurisdictions from all around the world, it shows that it's not just a European story, but that out of that 138 jurisdictions, 114 of them confirmed that they require all or almost all their domestic publicly accountable entities to use IFRS. And in fact, only 8 of those that were profiled don't require or permit the use of IFRS by their domestic companies. But it's not just sort of what happens on paper. I think what's more interesting for me is the fact that people really see the benefit of comparability. And that was shown in the responses that the European Commission got recently in their analysis of the effects of the IAS regulation, where the vast majority of respondents to that survey confirmed that they had seen an improvement in comparability as a result of the adoption of IFRS in Europe. And interestingly for me, it wasn't just across Europe. They made that observation that there was improved comparability within their own domestic jurisdictions. So I think that's a really big achievement for IFRS.
Okay, we are back. Now, let's start with, before going to the conceptual framework itself, let's start with what advantages exist with the adoption of IFRS. The first one I could say is that it assists businesses to present their financial statement on the same basis in which a foreign competitor will equally present their financial statements. Okay, remember a Nigerian bank, a Ghanaian bank, a Kenyan bank, a UK bank present financial statements, and they are presenting it in the same manner, using the same set of principles, which now make comparison. Okay, and that promotes free flow of capital across the globe. And evidence has shown from research that since the adoption of IFRS in Nigeria since 2012, Nigeria has experienced humongous flow of foreign direct investment in the last 10 years. Okay, until recently, where we have economic challenge and some constraints with respect to FX, but this has continued to more or less impact positively involvement and integration of Nigerian businesses across the globe. Another thing is that it has also allowed Nigerian companies to do cross-border listing. Example is Wando. Example is Access Bank. An example is GTB Bank, where they have Euro bonds, they've had global depository receipts, and every other thing in which they are listed outside Nigeria, including SEPLATs. All of this is because of the adoption of IFRS. Otherwise, there's a constraint that if you want to do dual listing, that means you have to be doing dual reporting, whereby you report based on Nigerian SAS of those days, and you still have to report based on IFRS in those countries. But today, one single reporting serves purpose in Nigeria and equally serves purpose anywhere in the world. Another thing is that it has made it easy for the consolidation of foreign subsidiaries. Remember, those days you have subsidiary probably in Ghana using Ghana standard, and the parent is in Nigeria using Nigerian standard. You can't consolidate unless you first of all convert the account of Ghana to Nigeria using Nigerian GAAP before you can consolidate. But today you consolidate straight forward because IFRS standard as used in Nigeria is what the Ghana company might have adopted or the UK company might have adopted. And finally, foreign companies which are targets for takeover or merger can easily be appraised, which means due diligence with respect to financial performance, financial position can easily be carried out, unlike before where you need to, if a Nigerian company wants to acquire a company in Zambia, for example, and Zambia is not using IFRS, you need to first of all engage professionals in Ghana, in Zambia to more or less convert that position to the position of IFRS for you to have better understanding and appreciation before decisions are taken. But those are more or less taken out of it. Okay, these are benefits of it. And to you and I, according to what Segun has said, Segun works in France. He lives in France. He's a Nigerian accountant. He's Nigerian trained. But what makes him to be able to fit in culturally, what is able to make him fit in professionally in the field of financial reporting or finance is because in the last 10 years or more, he was trained based on the same standard applicable in France. Okay, similarly, Bemi is in US and you use the same standard if you are operating within a multinational or a company that is listed on the US stock exchange. Do you get what I'm saying now? And these are the beauty to us as professionals. Okay, now, does it come with its own disadvantages? The answer is yes. IFRS as a standard has its own cost implication. For example, of recent, effective 1st of January 2018, we moved to the adoption of IFRS 9. And IFRS 9 comes with something that is so significant with respect to ECL model for impairment test. Okay, ECL model means expected credit loss model. It comes with its own cost. Banks, for example, in Nigeria and every part of the world, have to incur cost in creating a new database management structure, in obtaining data, how to spend money in acquiring software that can handle large data, real-time data towards carrying out impairment assessment with various algorithms, incorporating macroeconomic objectives and dynamics to it. These are costs that will have been avoided if we are using our local GAAP, which is more or less straightforward. But the question is it about straightforward or something that reflects the new true positions that can now be available for effectiveness of decisions made by stakeholders? Another thing we also look at is that there is a belief that by some people that there is a lower level of detail in IFRS standards when you compare it to standards like US GAAP. Because US GAAP is rule-based. Therefore, the detail there is like sacrosanct. It's like there's a checklist that every company must adopt such that it's more or less dogmatic. The standard, the template has been created by the FASB to the US GAAP, where everything is just completed on a plug-in basis. But IFRS is not so, even though we have basis of presentation of financial statement, the guidance that is given in IAS1. But the question is that a lot of latitude with respect to what you disclose, manner in which you disclose them, what you measure, what policies exist in making choice within those available methodologies. How do you present information and giving latitude towards judgment, which more or less make it like some people see it to be inferior, or because it's built up with some level of subjectivity when you compare it with US GAAP. But again, when you put the pros and the cons, you ask yourself, which one is better off in the long run? And the US authorities, through FSB, has also realized, especially the Securities and Exchange Commission in the US has realized that this is the way to go. But again, we all know the narrative and the superiority complex that exists within the US as a country. Therefore, they won't want to jettison theirs totally. And that's why what has been embraced today is that quoted companies in the US present account in accordance with IFRS, but local companies still make use of US GAAP, okay? But the beauty of it is that trajectory, dynamics are changing towards embracing IFRS as a global reporting standard. And that speaks to that, okay? But now, let's now start our discussion on conceptual framework. Now, we are going to start looking at those chapters one by one. Okay, remember we said we have 8 chapters. And those 8 chapters, we are going to demystify it one by one. The first chapter deals with the objective of financial reporting. And the summary of it is that, which we speak to yesterday, that the primary objective of financial reporting is the ability for such a system to produce financial information, including non-financial information, for the sole purpose of the users of financial report to have information available to them in making decisions or in making sound economic decisions. What it simply means is that all what is expected of financial reporting system is to make available such information about the activities, operation, performance, and the position of that entity at a point in time to the users of financial reports or to the stakeholders. The essence of that is to assist them in making decisions. Now, the decision varies from users to users. What a user will require it for might vary from another user. For example, we identify users of financial reports. And from my own identification, I subgroup them into external users and internal users. Internal users are those that more or less are involved in such activities of business on a day-to-day basis. External are those that require such information intermittently or periodically in order to keep to the pace of those that are internally operating along with the business. And therefore, let me share a screen of certain narratives I put up together with respect to users of financial information. Okay. Now, for example, the internal users or the internal stakeholders may include the management, the board of directors, may include the employees, the worker union, and the owners. When I say the owners here, it's more or less talking about owner-managed businesses, private companies, that the board is the management, they are everything. Okay, they are all internal users. While every other stakeholders, shareholders of a quoted company, they are not involved in day-to-day operation. They know nothing about it other than what is reported. Potential investors, vendor suppliers, financial institutions, government and its agencies, their customers, competitors, analysts, sell-side analysts, researchers, and even the general public as a whole. They require this information, and the decision varies from one place to the other. The decision of an employee is how is the company performing so that we can demand for increase in wages and salaries, so that we can demand for bonuses and productivity pay. Management is interested in how efficient I am so that I can be able to continue to manage this business and earn more of executive bonuses. The board is going to use it to appraise themselves whether the direction to which they give a strategy to the business is sustainable, okay, and an evaluation of whether they are on the right track and whether they are more or less achieving the objective to which the shareholders has appointed them in order to steer the ship of the organization. Now, to ordinary shareholders like you and I, they're interested in returns. How are they performed in terms of giving us returns? How are they socially responsible so that this company will continue to be in existence on a sustainable basis? Okay, potential investors want to look at the prospect of that business in making future profits and remaining sustainable. Suppliers want to see that before we avail you credits, do you have that credit quality? Do you have that capacity? All of this will be appraised from the information made available. Lenders want to see your capacity in terms of whether they can avail you credits. Government is interested using the information from the financial statement or financial report as an input to economic and statistics for the nation. Part of it is used to compute gross national product, GNP, gross domestic product, GDP, economic statistics in terms of inflation and some other performance index. Similarly, government agents also use it in tracking revenue relating to taxes to government. Okay, customers want to see how the company is fair, whether the company is not unnecessarily making profit at their own expense, and whether the company is such that the loyalty will continue on the basis of personalization of the products, on the basis that this company will continue to operate into the near future. You won't want to buy a phone from a company where you believe that that company might not last for long, which means once the company is out of existence, you have no support system for such phone again. Therefore, you want to stick to a company where you know that the phone can still continue to be supported as long as possible. Competitors want to look at your financial statement to be able to pick one or two things about your strengths, about your weaknesses, about opportunities that portray based on your strategy you have communicated, and probably the threat that you face, which might also turn to be a strategy of tapping into or creating opportunity to themselves. Investment analysts, researchers, they want to know more about you. Therefore, the information will be provided in such a way that they make their decisions, such as advising their own clients, whether to buy more of your shares, whether to jettison more of your shares, or whether to hold on to your shares. And the general public also want to see, majorly from the perspective of how socially responsible are you as an organization in complying with environmental policies, in complying with issue of more or less meeting the demands of your immediate business environment, of your immediate community, and all of this. These are what is taken into consideration as the need for having financial information for the purpose of making decisions. And that's that about the objective. Okay. Now, we also now have to move to chapter 2. Chapter 2. Okay, now before chapter 2, the information you have to provide are coming in 3 sets. The first information you have to provide will speak to the economic resources that is generated by the enterprise. The second information speaks to the claims that will be passed on to the entity. And the claims comes in two ways, and we are going to see that from the element of financial statement. There's a claim over the asset of the business, and there's a claim over the net asset of the business. What is the difference? And thirdly, the information is about the changes in the economic resources and the claim over a period of time. Okay, we are going to see that. And that speaks to what financial reporting produce as the end product, which is it produces information about the financial position, it produces information about the financial performance, which speaks to profitability and the cash flow of an enterprise at any point in time. Okay, those are the information that will be passed out. Now, this chapter 2 introduces and exposes us to the fact that mere producing information is not sufficient for financial reporting. There are minimum demands in terms of qualities. There are minimum demands in terms of standards, in terms of attributes that every financial information must provide. Okay, the first thing is that, do you really identify what are the qualities that come with the financial information for it to be considered reliable for decision making? Remember, not all information you come by, you deploy for the purpose of you making decision. You make decision solely on the fact that you place reliance on such information before decision is taken. The question is, what attribute have you found in the information that allow you to place reliance on it? And that speaks to the fundamental attributes, the fundamental qualities expected of a financial information. We are going to discuss that. Second, those fundamental attributes cannot be attained, cannot be achieved without the existence of other qualities that serves as a factor towards ensuring that we achieve or we maintain those fundamental qualities. Now, let me put up my notes. Conceptual framework. For financial reporting. Now, the first thing we identified was the objective of financial reporting. And we concluded that the objective is to provide financial what? Information to the users of financial reports for decision making. And decision varies from one user to the other. Now, we are at the juncture of identifying the qualitative attributes or characteristics of a good, in principle, financial information. As I've said, I'll use a diagram to explain these qualitative attributes. qualitative attributes. I said the first one is a fundamental attribute. And these fundamental attributes are what gives reliability to a financial statement. And these attributes include the relevance of the financial information and act faithfully as the financial information represents what has happened, which means faithful representation. Now, when do we say information is relevant? The conceptual framework makes us to understand that information is relevant given that one, it has the ability to influence decision making. And two, it is something that is provided at the appropriate what? Time, which means timing is key. And this that we are talking about for relevance comes with two things. One, information is relevant on a material basis if it gives a predictory value and or it gives a confirmatory value. Let me clean it so that I can write it well. A predictive value is that financial information should be capable of presenting you with a lead towards making prediction. It's not necessarily an information that will predict, but at least it provides a lead, a basis to which certain forecasts, certain projection, certain prediction can be made. Because when you talk about decision making, even though you rely on information from the past, but such information should give you a lead towards the future, because decision making is not made for the purpose of the past or the current, but for the future purposes. Which that means that such a financial information should possess this quality. And even if it cannot give you a predictive value, but at least it gives you a confirmatory value. A confirmatory value in this sense speaks to the fact that the information more or less gives you more or less a comfort or a head towards ensuring that what you thought exists, what you have a belief in, or what you expect is confirming that that position is right or that position is what is wrong. Which means that information is equipping you with something sufficient in making judgment or decision at that point in time. Which means it's providing you with sufficient information that is at least adequate for decision making. And on the basis of this, we consider materiality of such information as relevant. Information that is so material to your survival, to your existence, to your decision making is as relevant as anything. And therefore, that is what we are talking about. We also go further to say information faithfully represents what it is if it meets all of the following. One, this information must be free from bias. When it's free from bias, what we mean is that it is neutral. Because remember, the information you are providing is a financial information for general purpose financial statements. 2, it is free from errors. Material errors in this case, which means there is a level of accuracy, even though nothing is accurate in life. But you seek accuracy, which means to a greater degree, it portends a fair representation of the financial position, financial performance, and of the cash flow of an enterprise at any point in time. And lastly, it is free from omission. Omission means completeness is key. Completeness means that no information that is germane or material to the understanding of the financial statement for the sole purpose of making decision is not omitted. Because omission of it might have indirect influence on the decision making. Therefore, these are considered the primary factors that speaks to the quality of financial information. Now, there are other factors that are considered complementary factors. I'll draw up the line down here to see those other factors. Those other factors is what I can call factors that enhance qualitative characteristics. And what are these factors? Let me list them. I'll manage to list them here. 1 is comparability of the information. If you remember, there was a key emphasis made by the former IASB board chairman, which speaks to the conceptual framework has improved comparability based on amendments. And comparability speaks to 2 things. It speaks to consistency of information and the depth of disclosures. 2, verifiability speaks to the fact that information is only reliable for decision making if it can be verified in any manner, whether directly or what? Indirectly. 3, information is reliable if it is timely, as we are portrayed under the relevant position. And lastly, the information is reliable if it can easily be understood by the users of financial reports, because you only take meaningful decision, or you are perceived to have taken sound decision on the premise that you understood the information made available for the sole aim of you making such decision. And that speaks to that. And I've said earlier, comparability speaks to 2 things. It speaks to consistency of information, and 2, the depth of what? Disclosure. Why verifiability, by the word verification, speak to two things. Are you carrying out direct verification? Is it an information to which you can directly verify? And at least where you cannot directly verify, is it an information that indirectly can be verified? Now let's put it to you. I want somebody to answer this. What are the sources of direct verification of a financial information by the users? Can somebody raise up hand and let me grant you access? Hello, I've not seen anybody show hand. Okay, let me call Mr. Sunday. I know you're an auditor. Speak from your own perspective. Mr. Sunday, we are waiting for you. We can't hear you, Mr. Sunday. Okay. If you're not there, Grace Scholar Ole, you came in. Can you unmute and put up something? Grace Scholar Ole?
Yes, sir.
Yeah, we can't see your face. Can you put up your camera? I sent you private chat before. Let's see your face and kindly contribute. Yeah, the rule is.
Okay, let me just contribute. These are information we obtain as auditors. I'm an auditor. They are information we obtain directly by ourselves. For instance, like bank circularization, the evidence we obtain directly. So I believe that that's direct verification.
Okay, how can you verify?
When we circularize, when we send letter to the bank, then they respond to us. When the client send letter to the bank, they respond to us. So we confirm it's more authentic to us as auditors.
Yeah, all of that is still direct verification. The word direct verification means that documentary verification or physical inspection. What you can see, you can do everything. But how do you verify if a company chose useful life of 8 years for their motor vehicle?
From the company policy.
Okay, that means if the policy now say 20 years, it's also okay, Abi?
If we say 20 years and we're looking at the assets in question, we should be able to advise them that the year is.
On what basis are you going to advise them? What forms your judgment of advice?
Yeah, I can consider the capital allowance rates and say, okay, for taxation purpose, this you can only enjoy the capital allowance for so number of time. So if you keep depreciating, there's nothing you enjoy from there.
Yeah, but
I can use that as
capital allowance or tax you have no rule for financial reporting purposes. Therefore, why then use that as a basis?
Well, because that is one of the way they enjoy, that is what they enjoy to get more to get a reduction in their tax.
Yeah, so that's managing tax has nothing to do with financial reporting. Okay, the question then is tomorrow, if tax authority now change capital allowance rates so that asset can only enjoy capital allowance for 2 years, you also use that basis to advise for them to change the policy to 2 years.
Well, the useful life, I'm looking at the assets. How long can these assets last? You know, I can use that
to advise. What I'm trying to force out of you is that Indirect verification is how you verify the reasonability and the validity of the assumptions of the judgment and of the basis of estimation that's carried out by management. For example, if a company tells me that their policy of motor vehicle for trucking is 8 years, I won't argue with you, but the simple judgment, which is also one of the responsibility of auditors to assess, is to say, you are not in the business for the first time. You have been in business for 20 years. Can we just look at historically how long has your asset physically last? Can we also assume that if you tell me 8 years, and we are all aware that the truck will be driven from Apapa to Ijoya to Ajegunle and to other things, where the roads are very bad. The question then is, how reasonable can you say such a car will last 8 years? Which means verification is not necessarily just documentary, but also a test of assumption. Reasonability test of the judgment is also key to that. Now, when you say a receivable has not been impaired, the question is, when you look at the economic event, the company that is owing you this receivable has now experienced challenges because of COVID-19, and they are unable to open because they are into hospitality. And over years, government policy has always been banning hospitality. The question then is, and you are still telling me that they can pay. Do you understand? The question is economic events, macroeconomic variables, government policy, and some other things already serves as constraint to the business. And you are not saying it's not impaired or there's no evidence. The question then is, no, how reasonable is that? Which means you are indirectly assessing how sound such a financial information is. Okay, but that is what we are just trying to point out. Now let's move further. Timeliness is key as a factor. And finally, understandability. Understandability speaks to two things. It speaks to capability. Of the users of financial statements. And it also speaks to presentation. That is order of what? Presentation. How information is presented. And this was what led to the development of IAS 1. IAS 1 is a standard that tends to standardize how every company presents financial statements. When you print financial statement of small company, big company, multinational, foreign companies, and etc., you find out that there's no material difference in all of the look of the financial statements. What might be different are the amount, are the disclosures relating to specific information about the business strategy and some other things. But virtually, when you study it, you find out that all of those information and the manner to which they are presented looks alike. It's because it has been standardized. And it has been standardized in order to ensure that regardless of where you find yourself, once you have the capability as a user of a financial report, you can examine and try to appreciate and understand any other information gotten from any other company through their financial statement, which means there is no burden on you to learn different types of financial statement for you to have understanding of. Imagine you are a multiple investor in various companies, and the order is not standardized. Therefore, you need to now be tutored, or you need to invest much more in having to understand different financial statements, which is not necessary. which more or less is onerous to the objective and principle of financial reporting, which speaks to the fact that the benefit of financial reporting at all times should outweigh the cost. Now, that is that. And when we get to financial statement, we'll see the order of presentation as is required by IS1. Now, let's look at chapter 3. This is what we just discussed, and the details, as explained, is also provided. I think I've shared this material with you. If not, I can send it again. Okay, chapter 3 speaks to the financial statement itself. Now, when we say financial statements, I want one or two persons to tell us more about financial statements. Steve, put up your camera and tell us more about financial statements. What's your understanding of financial statements?
Okay, so when you speak, when we talk about financial statements, essentially we're talking about the whole components involved in a company presenting things about its performance and all that for a specific period. So when you pick, or when you say a company is presenting its financial statements, how I like to put it is the company is presenting its report card, showing its diagnosis and how it's performed for a particular period. So if you take it, bring it home a bit, look at it from this angle, say, when you go to the hospital, say you want to do a comprehensive medical check. What a comprehensive medical check does is to tell you even things you're not feeling at the moment. So it's possible you have headache, but you don't know what's causing that headache. It's also possible you're not sleeping because of anxiety or one thing or the other, but you can't easily attribute it. When you go for a comprehensive medical check, it shows you a lot of things more than what you can easily say. But today, when you bring that to a financial statement, you then say this is the company presenting its health status, its reports that shows, okay, both performance and position. And then you look at it from the angle that for a company to run, you want to know that, yes, the company is both profitable and at the same time liquid enough to run. So when you pick the P&L or the income statement, you're looking at the profitability. And then eventually you go to the cash flow statement. It shows you also what the cash position of the company. At the end, when you then pick all those bits and pieces, of course, the balance sheet will be able to tell me your going concern status. If you're presenting a balance sheet where it's showing that your liabilities are higher than your asset, though in some cases, depending on your industry for how long, you might survive a bit. But if anybody who has little financial understanding sees that, they'll be able to say that there's a problem. So what a financial statement does at the end is to present the report card of the company, being in as comprehensive as possible, and at the same time, not bugging users with unnecessary information. So you say your report card for a particular period, because it's on for comparability as well. You would have presented maybe financial statements in prior periods, or you present 1 year or 2 year comparables. But at the end, what you're looking at is your report card for the period under consideration. You want somebody who has an average knowledge of finance to be able to say one or two things about the standing of the company without being too technical, and at the same time, without omitting vital information which are necessary that can aid an independent person in taking decisions on the basis of those financial statements presented.
Okay, thank you. Duncan.
I'm with you, sir.
Yes, what do you view as a financial statement? What is it in its real sense?
Financial statement represents the state of affairs of a company. It tells you how the company is faring, whether it's a going concern or if it's going to have a problem in the foreseeable future. So a financial statement represents, is a picture of how healthy the company is in terms of financially, how healthy the company is, and if it's able to sustain its operation into the foreseeable future.
Okay. Now, what conclusion can we draw from this? The conclusion from our own perspective, let me share my writing screen. Our conclusion here is that when you talk about financial statements, from our perspective, is a vehicle or a tool for conveying financial what? Information. That is financial statements. Which means everything you want to say about it is just a mere document that it's like, for example, you need something and that thing exists somewhere. If you need fuel in your generator, somebody must go and take the fuel from where it is, whether at the fuel station or at any other place you have it in your dump, and you carry it to your house and fill it in the tank. Which means financial statement is nothing other than a document that helps convey financial information, which is the heartbeat and objective of financial reporting as a system. Therefore, in a nutshell, I see financial statement as a simple document that conveys financial information to the users of financial report for decision making. Now, this financial statement has three forms. The three forms of financial statements, according to the conceptual framework, are as follows. Financial statement can be unconsolidated financial statements. And what that speaks to is that you are talking about financial statements of a single entity. That's what we mean by unconsolidated financial statement in the conceptual framework. Financial statement can be consolidated financial statements. A consolidated financial statement is a financial statement of a group. And what is a group? In the next 1 or 2 weeks, we'll get to that level where we'll more or less reappraise our understanding of a group. But at this level, we introduce that a group comprises of the parent and its subsidiaries, which means in a situation you have a parent-subsidiary relationship, you have formed a group such that the combination of the accounts of the two as if is of a single entity is what is presumed and concluded to be a consolidated financial statement. Now, the third one is the combined financial statement. The combined financial statement seems to share similarities with a consolidated financial statement, all in the basis that it tends to combine financial statement of two or more businesses or entities, but not necessarily a consolidated. What is the difference is that this is the financial statement of a group of companies with common individual ownership. And I will explain. If company A, okay, let me look at it like this. Let me use the diagram to explain it. Unconsolidated financial statement is financial statement of company A as a single entity. Whereas consolidated financial statements is a financial statement of a parent and a subsidiary, as if it is of a single entity. Which means you have a company that is a parent to another company. When you combine using the principle of IFRS 3 and IFRS 10 to bring them together, and on an ongoing basis, you continue to prepare the account, the product of that account is what we call consolidated financial statements. And in this case, you have the parent and you have the what? The subsidiary. But the combined financial statement is such that an individual, for example, okay, let me pick an individual, Mr. Investor, owns company A, owns company B, and owns company what? C. And because he's an investor, he has access to the financial statement on an individual basis. And what he has decided to do is to combine the accounts of A, B, and what? C. What it simply means is that you want to see if I'm to bring these three companies together, what would they have produced as my position, my performance, and my cash flow? Now, where the difference lies here is this. For a consolidated financial statement, you eliminate the equity of the subsidiary up to the point of acquisition, or at the point of acquisition. You all know what I mean, which we are still going to demonstrate. But for the second one, which is the combined financial statement, you are not eliminating equity because there is no interest in any of the company by the other, which means company A has no stake in company B. Neither does company A have stake in company C, and vice versa. It is one person that is holding them together, which is Mr. Investor, individual. And an individual has no responsibility of producing accounts. But this individual wanted to mimic the opportunity that combination of account present to see my picture of my investment portfolio as a goal. You decided to more or less harness similar principle of consolidation by saying, let me combine all of my businesses together and let me prepare financial statement to see them as one, so that I can see the asset portfolio, I can see the liabilities, I can see my equity positions, which is the aggregation of my invested capital and all profit I've retained over time in building and maintaining my capital. Which means in this case, there's no elimination as at the point of acquisition because there was no acquisition. These are individual companies that you are only combining the equity position, combining the asset position, combining the liability position, but you are still going to eliminate intercompany adjustments, similar to what we do in group. But the only difference is that there is no cancellation of the equity as we do in consolidated, because cancellation in equity for consolidation is because on one side there's an investment, which is replicated by equity on the other side. And that's why we cancel out. Here, there's no other side to it. Individual has all of this portfolio, which he needs to bring together to see the asset position of all of his group of companies. That's why we didn't use the word group. We use the word group of companies. It's different from a group. Group statutorily exists, even in company law. That's why yesterday we looked at Company and Allied Matter out of 2020. And in section 378 to 380, it speaks to issue of holding company and subsidiaries, which means group is recognized by law because investment link them together. But group of companies is just a nomenclature to collate all of the investments in companies of an individual together. Not that it is a group from a legal structure. And that's what we are saying now, which means if individual like you have 2, 3 companies and you want to combine your account, you use the same principle of accounting, starting from IS1 to combine it, with the exception of you eliminating the equity position similarly to the way we do it under group what? Accounts. And that speaks to that. Now, any question at this point? Any question at this point? Any contribution? Mr. Sunday.
Yes.
As an experienced and senior auditor, can you share more light to this for us?
Yes, like I'm actually looking at them. Buying financial statement like you rightly pointed out. And or maybe I should ask a question along that line. Is it possible? Well, what's your take? Sometimes because some investors, also because of business owners, they want to show a very robust net asset. They sometimes want us to combine financial statement is just to show a robust position to a potential investor or a potential creditor, and they may ask, I've seen a situation where I was asked to prepare a combined account, and in those companies, we have a situation where there are some level of intra-company investment. What do you think about that? Can we still combine such financial statement? there's some level of intercompany investment, and the owner of the companies who want those companies combined. What do you see to that?
Now, the first thing is, what do you mean by intra-company investment or intercompany investment?
Company A has investments in company B, and
Now,
he wants to show a combined position. I don't mean a group position.
Okay, the investment he has in company B, to what significance level or to what level?
Most of the time, they are not controlling interest.
They are not what?
Controlling interest, most of the time.
Okay, but you want to combine. Therefore, that is what, yeah, that's what IFRS is saying, that in that case, they can combine. It is for their own use. Combined financial statement is different from consolidated. And it will be qualified there as combined, not consolidated. You can only consolidate on the premise of control.
Okay.
Are you getting it now? But you can combine anything you want to combine once it is not consolidated. That's why every financial statement have to carry the name of financial statement if it's unconsolidated.
Okay.
If it's consolidated, it must carry consolidated financial statements. Okay. And if it's not consolidated and it's not unconsolidated, it must carry combined financial statements.
Okay, okay.
Are you getting it?
I get you. And that would be a kind of special purpose financial statement. Or
what?
Can we say that is now a special purpose financial statement?
Eh?
I think can we now say that that is a special purpose financial statement?
No, it's not a special purpose. It's a general purpose. What differentiates special and general is that, are you using other rules and principles other than IFRS?
Okay.
That means anytime you comply with IFRS 100%, it is general purpose.
Okay.
But if you have internal policy of presenting things in this way and manner, other than what IFRS says, it is special purpose, which is common to your internal management accounting and reporting.
Okay. Thank you.
Thank you. Okay, now let's now look at the financial statement itself, whether it is unconsolidated or consolidated or combined. It comprises of 5 components, which means any of them comprises of what? 5 components. What are the components? The first one is the statement of financial position, which speaks to the resources we have and the claims we have over the resources. And I will explain. The second one speaks to the statement of profit or loss and other comprehensive income. This statement is a 2-in-1 statement, but not necessarily to all companies. It's a singular statement if it's just purely a statement of profit or loss, which we also know as income statement. Remember, if you listen to what the former chairman of IASB said, he said, most of the time it's encouraged that all activities regarding your performance are reported to your profit or loss, except in a extreme situation where those things fall under other comprehensive income, which means the real measurement of financial performance is your profit or loss, not necessarily the total comprehensive income. Because the total comprehensive income encompasses the profit or loss and other comprehensive income. What this speaks is that if I have no transaction that give rise to recognition of items within the other comprehensive income, such as items leading to gain in revaluation, items leading to gain or loss on actuarial measurement for employee benefit, items leading to recognizing changes arising from cash flow hedge, especially for those that are effective portion, or you have issues that relates to currency translation adjustment for non-monetary items, or those that relates to fair value gains or losses attributable to financial asset that is measured at fair value to other comprehensive income. All of this, if you don't have such item arising from such a transaction, all what you have is a statement of profit or loss or an income statement, because that's a singular statement to you. But when you have at least one of these other items, automatically you have two statements in one. The first part of the statement is producing your profit for the year or loss for the year. The second part of it is producing other comprehensive income, which when you combine with your profit or loss for the year, gives what we call total comprehensive income. Now, the third statement is a statement of changes in equity, which speaks to the changes in the economic resources and of the claim in those economic resources with respect to the net assets, which means showing movement in your equity position between what it was last year and what it is this year. And there are two ways of doing that. The first way is that you need to show us the breakdown of equity into its individual components. And we're going to get to equity to understand what are the break or the components of an equity. Secondly, upon the individual component, you still need to now reconcile and show us the movements and what accounts for the movement between those individual components of equity, balance at the beginning and the balance at the end. And that is the objective of that statement, to give clear position, as equity is seen to be residual. Equity is seen not to be remeasured subsequently. Therefore, but we need to reconcile so that we know the position of that equity at every point in time. The first statement is a statement of cash flows. This is a deviation from the conventional principle of accrual basis of accounting, which underlines financial reporting. Of all of information in financial reporting, this is the only exception against the rule of accrual accounting. And the reason why is because we also recognize that, yes, profit is desirable, profit is required, profit is good thing, but profit that is not backed up with cash, which is the life and the heartbeat, because cash is king. No matter the level of profit, once you are out of cash and there's no support system, you are gone. Okay, therefore, our cash flow position, how do we explain it in a manner that can be understood by the users, other than merely just showing your cash position in your balance sheet? Therefore, let us break down the cash position into the three activities involved in every business. The core activity, which is known as the operating activity. The investing activity, which is key to the operation as a support system. And finance activity that make funds available for you to even run your business. And not only that, how has these activities generated cash and how have they consumed cash and at what level? These are the information that will keep users to have better appreciation and understanding of what is going on. So that, I told you yesterday that management seems to have asymmetric information about the business because they are involved on a day-to-day basis. Now, how do we move other users to that level of understanding and appreciation of what goes on a day-to-day basis? Is for us to provide them with sufficient and adequate information, such as this, to be able to put them on the same pedestrian. Okay, and that's what we're talking about. And finally, we'll talk about the note to the financial statement. Now, note to the financial statement is equally an integral part of a financial statement. It's not subordinating any of the statements. They are of equal prominence. There is none of these statements supersedes the other, because it's the totality of it that provides the financial information that is required by users of financial report to be knowledgeable, to be equipped towards making sound decisions. And therefore, we need to present this in an order that shows equal prominence. And that is key. Any one that is out of it, you no longer produce financial statement that is considered general purpose because they are of equal prominence. But the note to the financial statement support all of other statements by providing clarity, detailed information, disclosures, and some other information that is necessary for the users of financial reports to have better understanding of the information contained in the financial position, financial performance, the cash flows, and of the statement of changes in what? Equity. Now, IS1 presented order to which our note in financial statement should be presented. And we're going to see that the same IS1 present the order to which we present our financial position, our financial performance, and our statement of changes in equity. Slightly, I will show you, and I'm still going to give you a model financial statement that is made by the Big Four or the Big Six. Okay, I'm going to share it with you, and we are also going to project it. Okay, but before that, we also need to understand these three things. There are three things that are key. The first one there, okay, before these three things, one thing that is key is when you are producing financial statements, you need to identify the reporting entity. You need to identify the what? The reporting what? Entity. And that speaks to the fact that when you say you are presenting financial statements, which entity is it? That's why in the notes financial statement, the first thing you consider is to give background and general information of the reporting entity in line with IS1, which means if I present financial statement, I need to say that this financial statement is for Economic Green Finance Professional Services Limited, of which its principal activity is so. And everybody knows that we are talking about a financial statement that's unconsolidated, that is meant for a single entity. But if I'm preparing for a group, my reporting entity will not be the group, starting from the parents and enlisting the subsidiaries for people to have a better appreciation of what they need to understand before taking decision. And likewise, the reporting entity will be the collection of the companies that forms the group of companies if it's a combined financial statement. And that is key. Now, after that is where these other three key considerations are essential, starting from the fact of what is the frequency of reporting. A general purpose financial statement is a financial statement that is reported every 12 months, which is 12 months is a convention and the length of the period that make up a financial report. Okay, but there are exceptions to that rule. And the exception might arise as a result of commencement of a business. A business that commences in June and have its year end December may have the first financial statement to be less than 12 months. Or a business that commences in October may have its financial statements more than 12 months because you don't want to prepare 3 months. Or probably you have 12 months and you started in November and your year end is December. And you can't present 2-year financial statement because the minimum requirement for any financial report, no matter the condition, is 3 months. Therefore, it means you have to extend it for the 2 months plus the whole year, which is you are presenting 14 months from November 2019 to 31st December 20, which means there's an exception to the rule. But the exception is that there's no way you can present a financial statement that is below 3 months or that is above 18 months. But going forward, apart from when you commence a business, apart from when you cease a business, and apart from when you change your accounting calendar year, every financial statement must always be presented in a 12-month calendar period. And this must be stated at all points in time for people to understand that they are comparing like with like. If you show a comparative financial statement that is less than 12 months, and people are not aware because you lack that disclosure, therefore they will have made a wrong decision. And finally, is that events after the reporting date must be disclosed, whether they affect or they do not affect, whether they are adjusting or they are not adjusting. But when we get to IES 10, we'll discuss more extensively about that, looking at practical situation. And one of the most recent practical situation about it is COVID-19 pandemic, which brings about event after the reporting day, because the first time China will accept that there's a virus that is more or less like a disease to them was declared on the 31st of December 2019. But internationally, by WHO, it was pronounced to be a pandemic, which at that become a global issue, I think in February or January, late January 2020. The question then is, for those presenting financial statements before that declaration, which is those that their year end was 31st December 2019, such information, is it adjusting event or non-adjusting event? Second, whether adjusting or not adjusting, is disclosure is critical to the understanding of the financial statement. Because the financial statement will also give you a clue which will speak to predictive value, which means that information will prepare users of financial information or financial report better understanding about the future, which might likely change because of the new dynamics. And that is making that information more relevant for decision making. Okay, that is that. Okay, and also the foundation for preparing financial statement is laid on the assumption that the entity or the group of companies involved or the group is a going concern. Okay, and all because if it's not a going concern, the basis of our preparation of account will change. Okay, and there are other methodologies to presenting account other than what we use. What we use in line with the requirement of IFRS is premised on the fact that the business will continue to operate in the next future. But if it's not, we then need to change our methodology. The most common methodology, if you are no longer a going concern business, is to use what we call the breakup value basis, or what we call a forced transaction basis, or what is simply called liquidation value basis, which means you are not going to more or less prepare on the premise of future expectation of value, but rather you are going to prepare on the current realization of value. Okay, when we get to IS1, probably we'll discuss more on that. Now, chapter 4 will now expose us to appreciating the elements of financial statements. What are the elements of financial statement? I subgroup it into two. The first set of elements addresses our understanding of the financial position, while the next set of elements addresses our understanding of financial performance. What drives our measure of financial position are three items or three elements: the assets, the liability, and the equity. And likewise, we have two that addresses our element of financial performance: the income and the expense. Now, let me share this with us. The element of financial statements, those that measure financial position, assets, equity, and liability. Now, asset deals with resources, or I'll call it economic resources. Equity deals with claims on the net assets, while liability deals with claims on the assets, which means claims on the economic what? Resources. Now, we're going to look at that later. Okay, for financial performance, we have income and we have expense. And we are going to look at them one by one. Let's start with assets. When we talk about assets, emphasis is on the following. One, right. Two, the potential to produce economic benefits. And three, control. Now, when we talk about rights, I'm trying to annotate and put up a spotlight. Okay, when you talk about rights, what are we talking about? Rights are what, okay, let me say it like this. Rights that have potential to produce economic benefit takes many forms. And the forms it takes may include the following. Rights that corresponds to an obligation of another party, which means the rights that you have is an obligation of another, which means the right is that if you have to exercise your rights, somebody else is obligated to grant that your rights. And it can also be rights that do not correspond to an obligation of another party. Now, let me put a practical situation. If you have a receivable, it has a corresponding payable. Am I making sense? What it simply means is that such rights has a corresponding obligation with another person. Because when it is due and you must receive it, that person must pay. But there's a right you have that does not correspond. Some of it is this: your cash you have at hand does not necessarily have a corresponding obligation at the other side. Because the only, what seems to be an obligation is the legal tender that is backed by government of that country. Am I making sense? Or today, we now have a class of investment, Bitcoin. Bitcoin is not backed up by any country, government of any country. But it's a right that you have that once you want to use it to buy anything, you use it to buy. Once you want to change it to your normal currency, you change it. But the question is that there's no obligation at the other side that is held by another party. I'm just giving you that example to give you some clue about the right you have. Does not necessarily have to have a corresponding obligation by another party. Now, that is that. The second one is that we call it an asset, not because of its physical substance, not because of whether it's tangible or not, Even today, bulk of assets that bring economic benefit are not even tangible items. But the question is this: the potential to produce economic benefit is such that an economic resources is a right that has the potential to produce that economic benefit. For that potential to exist, it does not need to be certain or even likely, but that the right to produce economic benefit is inherent in that item. It is only necessary that the right already exists, which is the principle of saying it is an asset because it is controlled by you as a result of past what? Event, because it already exists. That right is in existence. It's not a right that is likely going to be in existence based on the trigger of an event. That is not an asset. Probably you can disclose that as a contingent asset. And a contingent asset is never an asset. Okay? And that's what we are talking about. And the final thing that makes attribute of an asset is the control and not ownership. Because ownership of an item does not necessarily qualify to be your asset. Because what we rely on in terms of asset is the economic benefit that may accrue. What is the benefit of something you own that you don't control and of which the benefit does not flow to you? Which means it's the control that matters in the recognition of an asset. And that speaks to the substance over form as a principle that says that the question is the party that recognizes an asset should be the party that enjoys the significant benefit that flows from such an asset. That's why when you look at IFRS 16 leases, you find out that even when you lease an asset, you borrow an asset, you are only granted the right of use of that asset while you recognizing it as an asset in your book by way of right of use. Is because what matter is not about ownership. What matter is about who has control over such economic resources that flows from that asset. Okay, that is what we need to understand. Okay, now the other aspect is liability. And liability also has its own attributes. There are three things present in a liability. The first one is the obligation. The second one is the potential it has to transfer economic resources. And the third one is that there is a present obligation in existence. Now, the first thing is when we say obligation, obligation can come in two ways. The first level of obligation is a contractual obligation. Obligation that is backed by the instrumentality of the law. What is also known as a legal obligation, because even when you are not willing, by law, you will be enforced to do your own part. There is the second obligation that is not enforceable by law, but based on nature and the substance and circumstances surrounding it, it is an obligation recognized for financial reporting purposes. Because of what? It has impact on the survival of the business. And what is that? A constructive obligation. A constructive obligation are all obligations other than a contractual obligation that has created a valid expectation in the minds of other parties, such that by morals, by standards, by ethics, you are bound to meet such obligations, even though such obligations are not enforceable by the instrumentality of law. But such obligations are required to be recognized for accounting purposes. Why? Because not recognizing it has future effect, because you not fulfilling the obligation may affect your relationship and dealings with your business environment or your stakeholders, and it draw effect, negative effect on your business and on your survival. For example, oil and gas company, they carry out community development services and engagement where they operate. Not by law are they bound to do most of those things. But for them to be readily acceptable within that community, they've created valid expectation that they are part and parcel of that community. They are there to also support the community. And the issue there is that they're not doing it by law. They can't be taken to court to say they must do it. No, that's not their responsibility. But the question is that they know that not doing it may affect their own survival. Therefore, they have obligation, because they have also created a valid expectation over time that these things, they are responsible to doing it. Give scholarships. And that's why such is recognized as liability, because of the commitment that has been made, even though they are not legally enforceable. Which means recognition of obligation is not limited to the legal structure or to the contractual arrangement. It's also extended to things that are not contractually agreed, things that are not legally admissible or legally enforceable, but they are morally, ethically, and business, by way of business orientation, enforceable, or you are liable to do. And in that case, we recognize that as an obligation. Okay, now we also state that the first criteria for liability is that the entity has an obligation. And any of this obligation or an obligation is more or less like a duty or a responsibility that the entity has no practical ability to avoid. Which means if you have no practical ability to avoid it as a result of legal or as a result of constructive, therefore it becomes an obligation that must be recognized. And this must always be owed to another party. Secondly, potential to transfer economic benefits. Obligation must result in transferring part of your economic resources towards the settlement. But again, it is not necessarily that at the inception it must be probable, but the potential of making settlement of it exists. And that's why I said the second criterion for liability is that the obligation is to transfer economic resources. And to satisfy this criterion, the obligation must have the potential to require the entity to transfer an economic resources to another party or parties. And furthermore, for that potential to exist, it does not need to be certain or even likely. But one thing that is key is that it is capable of being transferred, or because it currently exists. And that leads us to the third criteria that speaks to the fact that it is only going to be recognized as a liability for recognition purposes in financial reporting if it is present. And it is only present because it already exists. And it only currently exists because it arose from a past event. Otherwise, any such liability that does not arise from past events will be deemed not to be a liability, but more or less a contingent liability. And a contingent liability is not a liability. Are you getting it now? And that is the position at that point in time. Now let's look at the third one. Equity. When you hear equity, think of residual. Think of what is left. Think of what? Residual. Think of what is left. Okay? In that situation, we say equity by its nature, represent the residual interest in the net assets of an entity. Or you can simply put that it is the residual interest in the asset of an entity after deducting all of its liabilities. And that's what equity is all about. Which means at every point in time, your equity position is ascertained by way of this equation. Equity is simply the excess of your asset over your liabilities. That is expected to be the norm. But again, I can tell you that reverse might be the case because equity is expected to be positive because you're supposed to have a net of assets, or because assets should naturally be more than your liabilities. But reverse can be the case in extreme situation, which always lead to liquidation or bankruptcy of a business, where the liability has overgrown the equity and equity becomes negative, has overgrown the asset and equity becomes negative, which is net of a liability or net of liabilities. Okay, that is that. Now, before we continue, okay, I will entertain question immediately we come back into the section. Okay, currently we go on recess for 10 minutes and we return for the last 1 hour before we wrap up. Thank you very much. Okay, welcome back. Now let's continue from where we stopped. Let's move to the other elements. Income. Now, when we talk about income, what are we talking about? Now, we look at income as increase in assets or decrease in liabilities. Which results in an increase in equity. Thirdly, other than contribution to equity by equity participants, which is otherwise known as the shareholders. That is income for you. Now, what that creates is that income is not necessarily arising from your operations or from your day-to-day activities or from activities you carried out. You can have income even when activities are not carried out, but there is an event. Let me break it down. Component of income. Income attributable to a business can come from two ways. From revenue and from other gains, which is also known as other income. Now, who can differentiate between these two? Who can differentiate between revenue and other gains? Okay, Duncan, let me give you right to Okay, I'm giving you right to unmute.
Okay, so my understanding of revenue comes from the normal operation of the business, comes from the normal day-to-day activity of the business, from the normal line of business of the company. While for other gains, I can refer to as extraordinary, it can come from a normal transactions that are normal to the business, like sales of an asset or disposal of the subsidiaries and all those other stuff that are not related to the day-to-day transaction of the business.
Okay. Now let's look at it from this angle. As I have said, income is attributable to primary or principal activities of the business from the core operation of the business. Any income attributable to your operations, that is the ordinary course of your business, such is known as revenue, which is a subset of your income. Whereas any other income that cannot be attributed to your primary function or ordinary course of business or core operation, which is revenue, are considered as other gains or other income. Okay, that's why when we get to presentation of financial statement, you see the order of presentation in line with the requirement of the standard. Now, let me now break it down. Revenue must always result from activities, which means you can't earn revenue without an activity within your operation. But you can earn income without necessarily earning revenue and without necessarily involving in activities. For example, even if, let me assume that since COVID-19, you have not done anything as a business, you've shut your business up. But remember that your business have money in the bank, which are put on fixed deposits. Even without doing anything throughout COVID-19 since March last year to date, you are still earning income to the extent of interest income, even when there is no revenue. And what does that signify is that even when you have a property that appreciates in value, without doing anything, you have earned an income. But the question then is, income, anything that could result in an increase in your asset position, or anything that can bring about reduction in your liability, and such reduction in liability or such an increase in your asset impact your equity so that it increases the amount of your equity. And that cannot be attributed to you injecting new capital or making contribution to such a business. Such an increment in equity will be considered as an income. That's why income is not necessarily something that comes as a result of exchange or as a result of activities. Likewise, expense. Expense is like a converse of an income, which means expense is a decrease in assets or an increase in liability. That is one, which brings about decrease in equity. And this is considered not to have been attributable to distributions to owners of equity, which means equity participants. That is, expense is not until you buy. Expense is not until you enjoy service. Expense is not until you incur costs, because expense can equally be considered from different components. Expense could be your direct cost of making income. Expense could be your indirect costs, which are more or less operating costs of doing business. Okay, all of these are core expenses that result from activities and events. But there are situations where you have expense other than conducting activity, which we call other losses. Other what? Losses, which means in accounting, any loss arising from your operation of a business is considered an expense for reporting purposes. It's considered an expense for reporting what? Purposes. And that is what we are talking about here. Okay, let me try and share this slide. Remember, I discussed equity the other time, when it's positive, when it's negative. Okay, now one thing I omitted was trying to explain the component of equity. In this case, the component of equity can be broken down into two: share capital and reserves. Capital is statutory in nature. Reserves is a mix of statutory and your retained earnings and other categories of reserve in line with the requirement of IS1. And what are they? Capital reserve are still statutory, which may include things like share premium and some other statutory reserve. Like in Nigerian bank, you have credit risk reserve, you have some statutory reserve, to general reserve and all sorts of things. But other kind of reserves are retained earnings, which are your accumulated profits over time. Other component of equity are reserve that is created as a result of activities that bypasses income statement, which means activities that passes majorly through other comprehensive income or that affect equity directly through the statement of changes in equity. And example of them in practice is what I've shown here. Revaluation reserve attributable to revaluation of property, plant, and equipment. Fair value reserve for financial asset measured at fair value to other comprehensive income. Actuarial reserve, which attribute to measurement and remeasurement of actuarial liabilities from a defined benefit obligation. Cumulative translation adjustment, which is more or less exchange differences that arose from the translation of non-monetary balances. Okay, and cash flow hedge reserve, which is the effective portion of any cash flow hedge that is undertaken in line with the requirement of IFRS 9. All of this, we are going to come across all of them as we move on in this program. But where I'm going to is the income, as I've said earlier. Okay, and likewise expense in that manner. Okay, and that is that. Any question at this point before we move further? Any question, whether by way of chat or you put it up? Can you raise up your hand? Any question, any contribution before we move to chapter 5? Okay, if there's none, chapter 5 deals with recognition and recognition principle. Now, I'll just give you a clue. When we talk about recognition, okay, somebody want to ask a question. Okay, Steve, you can unmute.
Yeah, I was saying if you can review a bit the discussion on liabilities. I just wanted to pick back on when we're talking about constructive obligation and all that. So if you can just spend 5 minutes a bit, let's just recap it.
Okay, now, as I've said earlier, for liabilities, okay, we said when we talk about liability, there are 3 things that are key to identifying what a liability is, okay? Now, the first thing we talked about when we are talking about liability is that there must be an obligation. And we said obligation is what will practically impact your activities that you cannot avoid. And such impact will lead to you transferring part of your economic resources or benefits towards fulfilling that unavoidable situation. And thirdly, we said, for it to be a liability, not only that it's an obligation, not only that it has potential to transfer economic benefits, but that it is present or because it arose from a past event. Now, your question borders on obligation. I said obligation can come in 2 ways. The first obligation is contractual in nature, which is a legal obligation, or because it arose from contract between 2 or more persons, or contract you have between another party or parties. And that contract is admissible in law such that if you fail to meet your own part, you might be held liable in a competent court of law. And that is contractual. Contractual obligation is more or less easy to identify. But there's another obligation, which I consider to be constructive obligation. Any obligation that is not legal or that not arise as a result of contractual agreement or arrangement is considered constructive obligation. Why? Because your pattern of past practices, your pattern of relationship with someone, valid expectation you have created in the mind of others, and they have seen it over time as your responsibility, becomes an obligation because it's something you cannot avoid. In that case, we say in accounting perspective, you recognize such an obligation. For example, if you situate your agri processing plant in Ikorodu, okay, and before you situate it, you more or less experience some challenges of Omonile community and everything, trying to agitate that, no, we don't want you there because it could constitute industrial hazard. But over time, you had an arrangement and you make them realize that, no, I'm here even to serve your own benefits. And over time, you guys have had an arrangement whereby you have been able to convince them that you are here to give them benefits so that the successes of the operations you are carrying on there will equally impact them positively. And by so doing, year 1, year 2, you started to make some scholarship, provide this, provide that. And over the years, you have created a valid expectation that it is normally expected from you to do it. So that when you fail to do it at a point in time, you start to see agitation. You start to see bottlenecks. You start to see issue of protest and some other things. We are saying that such obligation is due for you to recognize so that it even qualifies that if you have not carried it out, to a degree to which you can estimate the amount involved towards your own commitment, you recognize as an obligation because of what? If you fail to do so, you know that peradventure, you don't do what you need to do. They might disrupt your operation. I remember losses could arise from such. And that's why we said a constructive obligation are obligations that are not necessarily legally admissible, but they are obligations that you have created because of your action in the past, which has created a valid expectation in the minds of others, and which you need to take into cognizance in reporting your liability. Does that make sense, please? Okay, I've given you access to your mute. Does that make sense?
Yeah, yes, it makes sense. I think the part I really wanted you to stress is that fact between the difference between constructive and contractual. So it's fine. Thanks. That makes sense.
Yeah. Once I send the material so you can read further on it. And when we get to IS 37, we'll discuss more extensively on constructive and contractual obligation when it comes to making provisions. Okay. Now let's go back to chapter 5, recognition and the recognition. When we talk about recognition, what we are talking about is very simple. We are talking about how do you bring into the books of accounts and items of asset, liabilities, and equity, that is element of financial statement. What do you need to look for, or what is the process involved, or what is the condition precedent to recognizing or to bringing into the books of account an item of asset, liabilities, or equity. And the recognition principle is trying to tell us what condition will make you to remove an asset, to remove a liability, or to remove equity from the books of account of an entity. Okay, now in that vein, the simple process of recognition is that two conditions must be met for recognition of an element of financial statement to take place. The first condition is this: it must be probable that there will be a flow of economic benefits arising from such an element, if it's an asset, to the entity before you can recognize an asset. While for a liability, before you can recognize a liability, it is also probable that there will be an outflow of economic benefits taken away from the entity. Therefore, in that regard, you are going to make a recognition. Okay? Therefore, we are saying that that is a general principle. The second principle there is that even when there's a potential to transfer economic benefit or to receive economic benefit attributed to this element, one thing is also key before they can be recognized. They can only be recognized when they can be measured in money terms. Remember the monetary measurement concept that says only items that can be measured in monetary terms are accounted for. The word accounted for means that they are recognized in the books of account, either as an asset, a liability, or an equity. That is the general principle of it. Apart from the general principle, once you get to individual standards in IFRS, like IAS 16 for property, plant, and equipment, inventory, IAS 2, intangible assets, IAS 38, we go to liabilities, we talk about provision, IAS 37, we talk about financial instrument, both asset and liabilities, IFRS 9. You get to understand that there are specific requirements for the recognition of assets and liabilities based on the nature and the characteristics of those assets and liabilities. But the general principle of recognition borders on the probability and how probable it is that there will be inflow and outflow of economic benefits that affects the entity, and the reliability to measure those items or elements in monetary terms. And that's the general principle. Okay, and that speaks to the fact that there's something that the former chairman of IASB mentioned, which I don't think any of you picked, because when you make your presentation, I didn't get that from you. And what was that? And I'll put it to you as a question now, and I want you to answer it. If there's a conflict between the general principle of the conceptual framework and the requirement of a specific IFRS standard, which one take preeminence? Which one prevail? Which one supersedes? Raise up your hand if you want to answer. Which one supersedes and why? I've not seen hand. Okay, let me call someone. Shegun.
Okay, based on what the man said in that video, he said when there's a difference between the conceptual framework and a particular standard, that's that standard take prominence over the conceptual framework. So I don't really know the rationale behind that or the reasons, but I think the IFRS standard take prominence over the conceptual framework.
Okay, Babajide said IFRS. Who else? Anayo.
Hello.
Yes.
Okay. From that video, I think the chairman said the conceptual framework will supersede, basically because there are some things that the standard might have not captured, that is, might have not considered the peculiarity of that organization. So I think the conceptual framework supersedes.
Okay, who else? Dean?
Okay, according to the presentation, he made us understood that in the case where there is conflict between conceptual framework and IFRS standard, he said that does not mean that conceptual framework is superior over IFRS. Meanwhile, IFRS prevails.
Okay, which means what you are saying is contrary to what Anayo said. Okay, let me look for an umpire. Who else? Is Steve raising up hand? If you are raising up hand, can you contribute? Okay, Gbemisola.
Okay, so I'm not going by the video, I'm going by my own understanding, and I might be wrong, but I'll just say what I think. So I know that the conceptual framework itself is not a standard, right? So I don't think it will overrule any individual IFRS or IAS or SAS in this case. To the extent that there is a conflict, the IFRS will prevail over the framework. And over time, as the conceptual framework or as these issues or conflicts arise, the framework itself will take that into consideration for subsequent or future standards.
Okay, now thank you very much. I think you summarized it in total. If you listen to it carefully, he emphasized that though the conceptual framework underpins the development of IFRS standards. But in a case where there are disagreement or there are differences, the principle of the standard overrides that of the conceptual framework, which is contrary to the position if you look at laws. You know, at the beginning of the session, we more or less draw up an analogy by saying a conceptual framework is synonymous to a constitution, and whereas the standard is synonymous to acts and regulations that is drawn from the constitution. And we are aware that in law, since the act and regulation are drawn from the constitution, which implies that since the constitution underpins the act and the regulation, where there's a conflict, the constitution overrides. But in this case, for conceptual framework, it's not. And there's a reason behind it. The reason behind it is that conceptual framework is just a general framework. It does not specifically look into every activity and try to develop specific standards that address those activities, which means the depth of work that goes on in addressing specific issue rather than generalizing it as considered more substance and more other factors that have allowed them to reach such a conclusion. Which then means that rightly or wrongly, where there is a conflict or not alignment, you have to stick to the position of the standard. And that is what always leads to either the amendment of the standard or the revision to the conceptual framework, so that as far as practicable, they are always in alignment, so that that principle will have to be established. And if you go by the requirement, the position of the revised conceptual framework, you find out that they've done some significant amendments that has more or less aligned most of the part of the standard and future standard that will be developed to the conceptual framework. Okay, part of it is the recognition or the specific section or chapter devoted for measurements, or because measurement before is not expressly contained there. And also, they provided guidance to which, at what point do you carry out these measurements? Okay. Another thing that is also there is that the word prudence was expunged from the former conceptual framework in 2010. Okay, and the issue of stewardship accounting. And that has made people believe that IFRS is no longer about conservatism, or it's not about prudence. But this conceptual framework has now introduced it to make people remember that financial reporting still has its basis and its root on prudence, which means conservatism, which means you should more or less be in a hurry to recognize losses, which leads to the expected credit loss model, than being in a hurry to recognize gains or income. And that is all what prudence or conservatism is all about. An issue of stewardship accounting, which speaks to the responsibility and accountability of financial reporting as a tool of management, communication of the performance, and management of the entity to the stakeholders. Okay, that speaks to that. Now let's look at chapter 6. Chapter 6, okay, the recognition, I've not mentioned that. Before chapter 6, the recognition speaks to the fact of at what point do you remove assets from your books? And at what point do you remove liability from your book? The general principle is this: you remove assets from your books only when you no longer have control. And you no longer have control when the following has occurred. One, you've disposed of the asset, or the right to receiving any economic benefit on that asset has expired. Okay. Secondly, you remove liability from the books if it no longer have present obligation. And you no longer have present obligation under 3 conditions. 1, the liability has been discharged. Discharge means that upon settlement, that liability has been cleared off. Second one is when the liability has been cancelled. Liability is cancelled by order of court if there is a dispute or court has made adjudication that you're no longer liable. And thirdly, the liability is more or less extinguished or removed from the books when it expires, which means by the nature of the contract, by the nature of the agreement, the time has elapsed so that that liability is no longer required. And that might be as a result of situation where you have an arrangement in such a manner that the person you are owing has told you that, okay, pay 5 million in full and final settlement of a liability of 6 million, which means automatically you more or less derecognize 1 million because it's no longer due for settlement. And liability can be removed from the books in part or in full. Similarly, assets can be derecognized in part or in full. And that speaks to that position. Okay, let's move to chapter 6. Now, chapter 6 speaks to measurement. Now, when we talk about measurement, I use this example a lot. When you buy a material, a cloth, and you want to sew it, you meet a fashion designer, and the first thing that fashion designer will do is to take your measurements. Measurement means that they want to take your sizes, which is an estimation of value for the fashion designer to be able to put up the clothes in form of a dress that has a fit on you. And what that signifies is that for financial reporting purposes, when we talk about measurement, is the means and manner to which we obtain the value of the element of financial statement, which means at what value are we going to recognize an asset, recognize a liability, or recognize an equity. And subsequently, at what value do we carry this asset, provided they are still in the books, at every reporting date, similarly to a liability. Now, and the conceptual framework was able to narrow it down that values can be ascertained from two methodologies. The first methodology is not far-fetched from what we know, which is the historical cost. And the second methodology is what we call the current value. Now, whether historical cost or current value, which we are going to delve into, there are factors that have to be taken into consideration before you determine which one is appropriate. The first factor is the cost constraint. The cost of financial reporting should never outweigh the benefits, which then means that if your adoption of a method of valuation will override the benefit, therefore you go for the one that is less onerous. The second thing you consider is the nature of the elements. Okay. The third thing you consider is the information that is available. Which methodology has sufficient information available so that it can give some level of reliability by the time the value is estimated? And lastly, you look at other considerations, especially when you have accounting policy options, where you are now going to choose one based on the drive and the strategic objective of the board. But one thing that is sacrosanct is that when you choose a method, it is more likely to constantly apply that method rather than changing the method from time to time. Because remember, part of the quality of financial reporting is the issue of comparability. And one of the components of comparability, or one of the components that guarantees comparability, is consistency of methodology, of policies, of processes in financial reporting. And that speaks to it. Now, when we talk about historical cost as a basis of measurement, we are talking about the transaction price in which that element was given rise to. What it means is that it is a price that took place by way of entry value as at the date that transaction took place. Which means as at today, when you are looking back to your value, we are still talking of the value that took place 10 years ago, which means it's not subjected to change, except if it has been subjected to depreciation or write-off. But what we are saying is that we are not picking the most recent value. We are still using the historical value because that is the convention to which financial reporting is based. And that is the basic or the basic what's it called convention for accounting preparation. Okay, now that is that. But as opposed to historical value, which has its own limitation, we now have what we call the current value. Okay, now the current value has three methods of obtaining current value. When we talk about current value, what are we talking about? We are simply talking about the value of an asset or liabilities based on its current condition and situation and time, which means we are looking at it that this value is the value that can take preeminence today based on if two or more parties are to transact on that particular element, be it an asset or a liability. And what are the three methods that you can use as an alternative to ascertaining your current value? The first one is the fair value. The fair value can be likely to the market price of an item. Even though when we get to IFRS 13, we'll discuss extensively on the three hierarchy of fair value. But the most valuable hierarchy of it is the market price, or what we call the quoted market price. Which means when we talk about fair value at this point, let us think about quoted market price, where market participants exchange value for an item. The second one is the value in use for an asset. The value in use for an asset simply speaks to the fact that if an asset by its nature or characteristics generates independent cash flows. Now, if you can project the cash flow into the future, and you discount it with the cost of capital, the sum of the present value of that is what we call value in use for an asset. Whereas for a liability, we call it a fulfillment value, which means a liability that have independent cash flow for settlement, if you can predetermine the old cash flow and you discount it to the present, the summation of the present value of a liability is what we call fulfillment value, which is speaking to the same thing as present value. Present value of the cash flow of an asset is called value in use. Present value of the cash flow of a liability is called fulfillment value. That is the second methodology. The last methodology is what we call the current cost. And this is synonymous to an entry value based on the current terms and condition. And that the easiest way to describe current cost is like using replacement costs for an asset like PPE. Okay? And those are the three methodologies to which you can obtain the current value of an item. Now, also, I've provided some rhetorics in it that also speaks granularly to historical cost and current value. As I've explained earlier, I've told you the current value measures reflect conditions at the measurement date, which is at the present. Okay? Whether you are using fair value, whether you are using value in use or fulfillment value, or whether you are using current cost. And I think I provide a guidance here. Okay, Wale, I want you to read this guidance on the table that more or less give us a clue about which value provides certain attributes and at what point do we use any of these values. Okay, I'm going to give you access. Kindly unmute.
Okay. In this table, we have measurement basis. We have information provided by the measurement basis and whether it's an entry or exit value. Historical costs as a measurement basis. Assets, historical costs including transaction costs to the extent unconsumed or uncollected and recoverable. It includes interest accrued on any financing component. So we said here that it is an entry value. For a liability, historical consideration as yet owing in respect of goods and services received net of transaction costs increased by any onerous provision It includes interest accrued on any financing component. That is also entry value. Looking at fair value as a measurement basis, the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. It excludes any potential transaction cost or sale or transfer. This was agreed that it is an exit value. Value in use, fulfillment value, entry specific assumptions as a measurement basis. Assets, present value of future cash flows from the continuing use of the asset and from its disposal, net of transaction cost on disposal. This is also an exit value. For the liability, present value of cash flows that will arise in fulfilling the liability, including future transaction costs. This is also an exit value. When we look at current costs as a measurement basis, for the asset, consideration that will be given to acquiring an equivalent asset at the measurement date plus transaction costs, it reflects the current age and condition of the asset. For liability, it's a consideration that will be received to incur an equivalent liability at the measurement date minus transaction costs. All these are entry value.
Okay, thank you. Now, what's the difference between entry and exit value? Entry value is the value if you are the one bringing it in. Exit is when you are to take it out. For example, if you are buying an asset, the price you buy an asset is an entry value. But if you are selling an asset, the price you will sell is an exit value. If you are incurring a liability, the price arising from that contract for you to have assumed that liability is an entry value. But the price you use to settle that liability is an exit value. Okay, that speaks to that fact. Okay, and I provided guidance to us ascertaining which value is more important to determine each categories of asset and liabilities. Okay, and that is what you can see in this schedule for further understanding based on item by item. Now, measurement of equity is only done once in the lifetime of equity. That is at the point of introducing equity or at the point of injecting equity. Because the first level of equity is capital. If you are just starting a business now, your first level of equity is money injected. But as time goes on, equity is no longer capital. Equity is the residual, which is a combination of capital, if it's not yet eroded, plus your accumulated reserve over time. Okay, if the reserve is positive, it continues to increase your equity beyond your capital. But if your reserve is negative, it continues to reduce your equity below the capital because the capital itself is being eroded. And we must know that going forward, at every reporting period, equity is going to be recognized as the balance, not necessarily going to be measured again by the nature of equity. Now, chapter 7 deals with presentation and disclosure. Okay, now I told you earlier that you find out that IS1 is the first point of presentation, which has provided us with the order, a chronological order to which we present financial information for the better understanding, having considered the capabilities of the users of the financial information. And disclosures are supporting details that better provide explanation that more or less limit the asymmetric information and also bridge the gap between the knowledge and information available to management and other internal stakeholders and the one available to the external stakeholders. And also, your presentation and disclosure also encompasses your accounting policies, also encompasses the assumptions that have been made by management, the judgment that have been made by management, and the basis to which management make estimations. such as which convention have you used, historical cost? At what point do you use fair value as a deviation away from your historical cost convention? All of these are also information that will be presented. Now, information will be presented based on individual class of items. And where it is practically possible, you can also present information of immaterial item by way of aggregation, which means information can be provided based on individual class, and certain class or items that are more or less non-material in nature or in amount can be aggregated and provided as a single class of item for the purpose of presentation and also followed by disclosures. That also is very key at every point in time, which means when we look at it, effective communication of financial information in a financial statement is premised on the following. One, focusing on presentation and disclosure objective and the principle rather than focusing on the rules. And that speaks to what we have said earlier about principle-based and what? Rule-based. Second thing we have talked about is classification of information in a manner that groups similar items together. And the similar items can be grouped also together in order to form an aggregation. And we also said something about aggregation of information in such a way that it is not obscured either by unnecessarily providing details that is not needed or aggressively aggregating items in order to suppress certain level of information to the users of financial reports. Okay, that speaks to that position. Now we'll move to the last chapter. Okay, the last chapter deals with the concept of capital and capital maintenance. As I've said earlier, effective communication of financial information in the financial statement is premised on classification, is premised on aggregation. Now, the principle of offsetting, before I go to the last chapter, the principle of offsetting is such that assets will always be shown separate from liabilities, which means every class of assets will be shown separately from every class of liability, which means at no point should you offset any liability as a line item against an asset as a line item, except in a rare situation. And what brings about this rare situation is that two conditions have to be fulfilled for offsetting to take place in a financial statement for an item of asset and liabilities. And these conditions are as follows. One, the first criterion is that there must be legally enforceable right to do so, which we call a legal criterion, which means by establishment of a law, that means that asset is created solely to meet that liability. For example, when you have a sinking fund provision in an arrangement with a third party, that you must set money aside, whether in escrow or otherwise, or in a defined benefit obligation where you need to maintain the planned assets of your employee for the planned obligation that you carry for those employees in line with IAS 19, employee benefit. In such a way, there is a legally enforceable right, or because for you to create a pension plan, it is created by instrumentality of the law. And secondly, there is a trustee, which you are, because what you are doing is that you are holding such a planned asset in a fiduciary capacity and in trust for your workers. And that's why you find out that when we get to IAS 19, you discover that even when a company collapses, the pension asset is not part of the asset of the company to be realized because it is only held in trust, not your own assets. And in such a way, we say it makes that condition. The second thing there is that not only meeting that legal condition, the other condition is this: by substance, the nature of that asset, was it primarily created solely for the purpose of realizing that asset before that liability can be settled? If it means that even if I find it difficult to realize the asset and you can't hold me liable to pay you immediately, it then means that the asset has been designated and set up solely for the purpose of meeting that obligation. Similarly to pension plan assets. If you retire and that asset has to be realized to settle you. You can't compel. That's why you see that even in the pension scheme, when you retire today, they are not going to pay you today. It takes some period of time because there's a process to realization of the planned asset. In such a case, we say the principle of offsetting can take place because the two conditions have been met. The first condition is the legal criteria, which speaks to the fact that is there a legally enforceable right, which we said yes. The second criterion is that is the asset created solely of which its realization is for the settlement of the liability. We said yes. In that case, you can offset. That's why you find out that in the financial statement, you find out that we show or we present net retirement obligation as a line item, rather than showing the retirement asset or planned asset separately and the planned obligation separately. No, we report it net, and that is that. And we're going to see that as we move on. But why can't we do that for leases? It's because, one, there's no legally enforceable right. Lease obligation is a separate liability. Even if it's not a separate liability and there's legally enforceable right, the second thing that's the problem there is that for you to meet your lease obligation, it is not preconditioned on you for you to sell the asset before you meet the obligation. Even when you cannot sell the asset, the obligation must be met compulsorily because that condition is what exists in the contractual arrangement. Okay, that speaks to that. Finally, we move to the last chapter. Now, who can tell me? I know you understand what capital is, but who can summarize the role of capital in a business, both at the origination and on an ongoing basis? Who can tell me the role of capital in a business? At this point, I'm going to give access to everybody to unmute, and you could come in and say one or two things. Okay, I'm waiting.
Okay, so when you talk about capital, we're talking about the initial amount injected into the business. So before when a business is set up, there's this initial pump in of cash flow that will be used in starting up the business. But as the business continue to exist and transact along the line, if there can also be additional injection of capital, if maybe there are new shareholders or the business just needs fund, maybe the liabilities is closing down on the asset, there can also be additional injection of capital along the line before it affects the going concern of the business. That's my submission.
Okay, who else? Who else? Okay, now let me summarize it. Initially, capital is required for setting up of a business. It's more or less required to put things in place for a business. But as time goes on, capital is not sufficient only to run a business. And that's why the critical aspect of financing is not capital, but it's more or less of debt, which we call liabilities, starting from trade credit, bank borrowings, issuing instruments like bonds, commercial papers, having bill of exchange, promissory notes, and etc. Okay, these are what more or less has a leverage or multiplier effect in growing business faster than using your own capital. But your capital is always for a startup. But now, your capital in the long run and on an ongoing basis will only play a role. And what role is this? It will serve as a buffer. It will serve as a shock absorber for absorbing losses that might arise in your business, because you can't transfer loss to claimants, that is to liability holders that have claim over your assets. Okay, and in that situation, what it simply means is that when you talk about capital in its real sense for a continuing business, think of it as a buffer so that when you make losses, it absorbs those losses. Because anytime your capital can no longer absorb the losses, the implication there is that such position is showing negative equity, which means you are in the edge of bankruptcy because your liability is more than what? Your assets. Which means capital is a buffer to a business. Now, also, to maintain this capital so that it can continue to serve as a shock absorber so that any turbulence or any shock is being absorbed, what you ensure is that that capital must be maintained. Like the way you maintain your car, your shock absorber cannot last forever. Therefore, you must always do things to ensure that you preserve it. Because you bought a Benz today, brand new Benz, doesn't mean you enter portal at every point in time. It will take little time for the shock absorber to run out. Which then means that what then do you need to maintain your shock absorber for a car is to ensure that at every point in time, you don't jump into a portal. Okay? But what then implies is that as time goes on, what you need to do at that point in time is that we look for what is used to maintain capital. And what can be used to maintain capital is your profit. Okay? And your profit performs the following rules. Okay? Now, the profit performs the following rules. One, before profit is available for distribution, the first thing profit needs to perform is that it's used to maintain your capital. That is why you find out that there is a dividend policy. And in the dividend policy, the spirit behind it is that you need profit to be retained for different reasons. The first reason to maintain profit or to retain profit is to maintain capital, because capital loses purchasing power as time goes on. Okay, the second reason is for expansion and growth of your business. It is when you have met these two that the excess over those two can now be used for distribution. And that's why you see that there's no nexus between the amount of profit in its real sense and the amount of dividend paid out for a real company, because you have to do internal assessment to first of all identify what portion of profit is for capital maintenance with respect to loss of purchasing power as a result of rising prices and inflation. The second one is that what future prospect do we have as regards growing organically or by way of merger and acquisition and by way of expansion. And the last one is issue of, okay, what is left is what can now be distributed as dividend to shareholders. Now, to maintain capital, we now have principles of capital maintenance. There are two principles of capital maintenance: financial concepts and the physical concept. What is the difference? Physical concept is looking at profitability measurement from the perspective of your production capacity or your operating capabilities. To say, if your production capacity at the beginning produces 10,000 units, and that same capacity at the end, without you injecting new capital, produces 11,000 units, it means you have made profit to the extent of 1,000 units, the value of 1,000 units, because at least you have maintained your capacity to the best minimum of 10,000 that you started with, which means anything you produce in excess of that 10,000 units in terms of capacity is considered profit that can be available for distribution. But conversely, the financial concept is viewing profit from the angle of the net assets. To say, peradventure, your net asset at the end is in excess of your net asset at the beginning. Given that there is no additional capital contributed and there's no distribution of equity to equity participants, therefore, such increase in net assets can be considered profit. But again, the financial concept view it from two perspectives. The first perspective is that it views from the perspective of nominal financial concepts and real financial concepts. Nominal means that it doesn't take into cognizance effect of general price, effect of inflation in general. Okay, which means from the perspective of that, inflation is not factoring into the measurement of profits. But the real concept factors inflation in the measurement of profits by adjusting for the general price index, which is also known as consumer price index, which is the average increase in prices of all commodities within an economy. Now, whereas the physical concept also consider inflation, but rather than considering inflation from the general perspective, it considers inflation from the specific price index. What is specific means that you look out for specific inflation rates as it affects your items or business. For example, instead of using general inflation index, which is more or less average, because inflation for different commodities vary. Today in Nigeria, probably foodstuff at highest inflation rate, while some other things have lower inflation rate. But when you average it, it's in the middle. But that average might not reflect your own inflation, because your inflation might be lower than that or higher than that based on the specific commodity that affect your own business, which means physical concepts rely on specific inflation rates, while a financial concept that is real-based deals with general inflation, while nominal does not consider inflation at all. And that speaks to the summary I have here. Okay, when you look at it, okay, I want somebody to read that. Nuruddin, can you read that? Nuruddin.
Concepts of capital maintenance and determination of profits. Capital maintenance concepts, practical aspects of applications and applications. Under these concepts, a profit is earned only if the financial or money amount of the net assets at the end of the period exceeds the financial or money amount of net assets at the beginning of the period, after excluding any distributions to and contributions from owners during the period. Financial capital maintenance
Okay, Wale, can you continue from there? Wale, can you continue from there?
Either nominal.
Wale, can you continue from there?
Yeah,
monetary
share your
unit,
screen, sir.
i.e., adopting the historical costs accounting or units in power accounting, CPP. Cost accounting, return of accounting over.
Okay. Accounting. Let me start from historical cost accounting. Represents the fundamental convention of accounting over time and up to the most recent time, which does not consider the effect of inflation, and neither does it adjust for inflation in arriving at a profit, which can be available for distribution to the equity participants or owners. Current purchasing power accounting, CPPA, is a slight modification to HCA, which is the case of CPPA. It takes into account the effect of general inflation as measured by General Consumer Price Index, GPI or CPI, within the economy for the reporting period. And same is adopted to adjust for the impact of inflation before profit is being determined as available for distribution where necessary. Fiscal capital maintenance, on the other hand, talks about Under this concept, a profit is earned only if the physical productive capacity or operating capability of the entity or the resources of funds needed to achieve that capacity at the end of the period exceeds the physical productive capacity at the beginning of the period, after excluding any distributions to and contributions from owners during the period. The method of accounting adopted under this approach is known as the current cost accounting, CCA. The concept of...
No, leave that, that's all. Now, you can further read it up, which is the same thing of discussed. Now, let's look at this example to depict that. Now, can you read this question? Farasimi.
Farasimi starts a business on the 1st of January 2018. Farasimi's sole shareholder contributed capital of 1 million naira. Farasimi purchased one item of inventory for 1 million naira and sold the inventory for cash at 1.4 million naira. As of 31st December 2018, the replacement cost of the same item of inventory is 1,100,000, the equivalent of 10% specific inflation rate. General inflation during the year was 7%. You are required to calculate the profit for the year and set out a summary statement of financial position as at 31st December 2018 under the following capital maintenance concepts: A, physical capital maintenance; B, financial capital maintenance; then historical cost accounting; constant current purchasing power accounting.
Okay, thank you very much. Now, what happened is this. To recognize revenue is very straightforward. You sold it for 1.4 million, which means across all the concepts, it is the same, 1.4 million. Now, it cost you how much? What you sold cost you 1 million. Across all, it's just 1 million. But where does the adjustment for inflation come in? For historical cost accounting, which is the financial concept for nominal, there's no adjustment for inflation, which is the convention we use in preparing account today. Okay, but for current purchasing power accounting, which is a real aspect of it, adjust for general inflation. And what is our general inflation index for the year? It's how much? 7% on a year-on-year basis. It means what it simply means is that what we bought for 1 million, if you have to buy that same thing today before we sell it, it is 1,070,000 because it has increased in price by what? 70 naira or 70 million, which is by 7%. And therefore, what you have to do is that before you claim that you made 400, as you can see it here, before you claim this 400, ensure that you have deducted that 70 and go and put it in your reserve so that that 70 is to restore you to restore your loss of purchasing power as a result of inflation. And that's why when you come here, you see that our capital will be adjusted forward through one of the capital reserve of 70,000 as inflation adjusted reserve. So that at every point in time, if you are to distribute, you can only be restricted to distributing out of 330. But there's also an argument by fiscal concept to say, no, yes, you have used inflation, but why are you using average inflation rates? What if your own inflation rate based on the specific of your own transaction is higher or is lower? That's why you find out that fiscal concept now use the specific inflation rates. Now, they said the replacement of the inventory we are talking about, which we deal with, has 10% inflation rate, which means you have adjusted for inflation. Okay, but we are adjusting for inflation at 10%, is 100 naira, which means instead of reporting 400 or 430, we are reporting 300 because we have adjusted for 100, which is used to augment our capital in order to ensure that at every point in time, the capacity to which our capital produces our resources is not reduced. It is only when it is increased that the excess over the minimum capacity level as we have it at the beginning, is what is recognized as profits at the end of the day. And that is what we are trying to say, okay? I've shared these resources with you. You guys can more or less diagnose it further. And also you can revisit the video. Once it is ready, it will be uploaded at that point in time. Any other question before we call it a day? Steve, what's your question? Steve, you can unmute. What's your question? Okay, I think it's not there. Okay, in the absence of no question, thank you very much. And God bless you for today. Okay, we'll see next week, Saturday, God's willing, by 10 a.m. Thank you very much. And God bless you all.
Thank you, sir. Thank you, sir.